Tell you the plan for a CMSL marathon. Very important is how you should plan it one day before the exams. Okay, so the very first thing is your syllabus is divided into 60-40. Okay, and we will have time wise, we will complete everything. Okay, so let's see. Keep your books, pen, modules, notes ready. Okay, as and with me you can complete this particular chapters. Let's see the plan for today. I have shared the amendment sheets on the notes. Till that, please confirm in the WhatsApp group whether I'm audible and visible so I can quickly start. Okay, just write audible, visible in the chat box so we start. Audible, visible in the chat box. Audible, visible in the chat box so we start. Yes. Okay. Great. Good to go. Okay. Hi students. So first let's decide the strategy what should be there for your CMSL paper. Now for your CMSL, your capital markets is for 40 marks. Okay. And then this 40 marks is very scoring and we can quickly complete it. So that will be our objective now. We will target to complete all the 7 chapters in the next 3 hours. Okay. So if I say next 3 hours means we should be done by 3 hours and you should be done by this part A by 5 p.m. Okay. After that, after we complete the part A, then you should target your part B. Okay, and your part B should be started from 5 p.m. onwards and you should do it by approximately in the next 4 hours, targeting all the important chapters, giving around 1 hour for big chapters and for smaller chapters 30 minutes. Then you complete this and then by 9 or by max you should complete this by 10 o'clock. Okay, 10-11 you should complete your second part also. In the morning when you get up, you have to revise again, but first you revise the part B and then you revise just before going to the exam. You will start with part A, right? So you will revise part A just before the exam, and also you should include studying the sums. Okay, so remember sums will come for around 10 marks. We have all it in the dream batch in the lectures. No sums will come outside of it. Mostly the sums are from mutual funds. Okay, or derivatives, which are very simple, and some ICDR sums are there. So sums are also very scoring, and the great part about sums is you can get full. Okay, so what is the plan for today? We will start knocking off the chapters in order and try to complete all of this by 5 p.m. So I want you to have the same target. If you don't have anything planned by yourself, if you have that, you can continue with that. But in case if you don't have any strategy as of now, we will complete all the 7 chapters in 3 hours. Okay, and then we'll go to the next part. Now, very important, just before I start, I will complete the amendments in 5-10 minutes. These are important amendments. When I say important means the other amendments I have seen is not that which they can ask in the exams or very relevant. Okay, or it must be already covered in the lectures. So these amendments we will start. Okay. So GTG in the chat box, I know that you all are ready and we can complete. Okay, everyone, GTG in the chat box. 7 chapters we will complete in order. First 5-10 minutes I will take the amendments, the important amendments, and then we will start completing 7 chapters. We will target to complete in next 3 hours. Okay, by 5 we should be done. I'm targeting my watch. You can target your watch. Let's complete the chapters together. Okay, let's start. Hi. So now we begin with some of the key amendments for your CMSL subject. Okay. Now the very first one is with respect to insider trading. I have shared these notes on the group. You can read it up. It's in the WhatsApp group. Okay. Now in insider trading, they have brought in an amendment with respect to regulation number 5, which talks about a trading plan. Sir, what is a trading plan? A trading plan is when an insider, let's say I am a promoter of the company, director of the company. So I become an insider of the company. I'm working in the company. I have access to undisclosed price sensitive information. So when an insider wants to deal in securities, they have to do it by submitting a trading plan which will operate 120 days later. Means it should not operate 120 days earlier. Okay. So I will make a public disclosure that, listen, in January I'm making the public disclosure that in December I will buy these many shares or I will sell in these many shares. So that's fine, because such a future oriented thing I will not have undisclosed price sensitive information. So a trading plan should not commence 120 days earlier than the public disclosure. So the moment I give a public disclosure of my trading plan, my actual trading of my purchase and selling of securities will happen 120 days later. Simple. Now in the trading plan, I will tell the company secretary that, listen, I'm a insider of the company and I want to sell my shares. So I am informing you, you publish it, make the public announcement of my trading shares that the promoter is wanting to sell, and this will operate obviously 4 months later, 120 days later. So after 5 months, this promoter will sell these many shares. Okay, how many shares, whether he wants to sell, buy, when he will sell, he can give a trading window of 5 consecutive days also. So I can say that I will sell it in 15th December or 15th to 20th December I want to sell. That is it. Okay. And when I set my price limit that I should sell it by XYZ price, the price limit should not be more than or less than 20%. Means the max difference of pricing will be 20%. For example, if the closing price, when I've given my disclosure of my trading plan, 1 day prior the share price is 100. So the trading plan cannot cover a trade that it will execute to buy at difference will be maximum 20%. So if yesterday's price was 100, I can sell at 120 or I can buy at 80 only within the 20% range. Again, a trading plan will be disclosed by the insider to the to the company secretary, and it will be published. In that trading plan, all the details will be given, and the pricing at which I will purchase, if I mention it, it cannot be more than 20% of the price before disclosing the trading plan. So that is it. 20% up and down is allowed. Okay. Now the question comes that if I have said in the very beginning of my trading plan, and this is interesting, in the very beginning only of my trading plan, I have said that I will sell it on 25th December. Now 25th December, which I have decided that those days I will knock off my shares. That time, if for some reason there is a window restriction, there is a trading window restriction on insiders, will it apply to me? Answer is no. So if a trading plan has been approved, it has already been published, then that will be exempt from a trading window restriction. Means even on 25th December, if the window is closed, trading window is closed, but my shares will be traded because I have already informed in the trading plan. Finish. Next, a trading plan, whether it is revocable. Okay, once, and this we always know that once I give the trading plan, then it is irrevocable. I have to execute as per the trading plan only. Okay, however, there are some exceptions where trading plan can be revoked. It is when permanent incapacity, bankruptcy, operation of law is there, then trading plan can is revocable. For example, if the insider died, or maybe he became bankrupt, or law has imprisoned him, or created operation of law by order of law, then it can be revoked. Otherwise, in normal circumstances, a trading plan once announced has to be trades will happen according to the trading plan only. Okay. Now again, all the trading plan etc. is informed to whom? It is informed to the compliance officer. Okay. So the compliance officer will either approve or reject the trading plan within 2 working days of receiving it. Okay. So moment the compliance officer receives the trading plan that this promoter wants to knock off after 120 days these shares, then I will decide. In 2 days I have to decide whether to allow it or not allow it, and I will inform the stock exchange on the same day. Okay, this was with your regulation number 5, trading plan amendment for insider trading. Next we see they have just added one small little point for your prohibition of fraudulent and unfair trade practices relating to Securities Act. Okay, there is a SEBI prohibition and of fraudulent and unfair trade practices relating to securities regulations. Okay, that there is one regulation. In that they have just added one small point that, so see, what is the regulation about? It is about prohibiting two things: fraudulent and unfair trade practices. So the prohibition is about fraudulent and unfair trade practices should be prohibited. Common sense. So they have introduced a definition, and they say that don't do this. So they have called as mule accounts, mule or dabba trading or fake accounts made. You know, you've heard of Benami transactions? So this is like a Benami account where funds are given by one and controlled by another. So that is called as a mule account. Sir, what is a mule account? A mule account is an account held by one person's name. My mom's name is there. I'm open the account in my mom's name, but it is controlled and funded by someone else. So someone else is having the name and someone else is operating it. So this is called as a mule account. It is treated as fraudulent, unfair, manipulative. Okay, and these kind of proxy accounts are no longer allowed. A special definition has been added and it has been prohibited under the Unfair and Fraudulent Practices Act in Securities Market. Simple. So what they have added? Mule account. What is a mule account? Name is one, operated by and funded by another. Such are not allowed. It's called as a proxy account. The next and another important definition is with respect to delisting regulations. Okay, in delisting regulations, very simple. Normally, if a company, now what is the rules of delisting regulations? That if a promoter is there, he wants to delist the company, a listed company wants to be delisted. So in that case, the promoters have to buy 90% of the shares, and then everyone else who wants to exit, the promoter should be ready to buy them out, give them an exit opportunity. Because after that, the shares will be that of a unlisted company. So here, normally in delisting, how it used to happen, only one method was allowed. That was the delisting was allowed only through the reverse book building method, where the options used, your particular auction used to be given, price band used to be given. In that range, people used to bid that at what price they will ready to sell. Then a price would be discovered, and that discovered price we would allow to be exited. Again, if today a company wants to get delisted, the promoter had to give a announcement to them that whoever wants to get delisted, I am ready to buy you out 90%, at least I am ready to buy out 90%. So in order to what price they will buy out, so the promoter used to give a price range. Within this range, you all bid who wants to sell their shares, and accordingly we used to discover that at this price 90% are exiting. Now they brought a new method that they've also allowed that, listen, fixed price also we should allow. So SEBI has introduced a fixed price process as an alternative to reverse book building. In delisting, now we will not only have reverse book building method, we will also have fixed price, which is more simple. Promoter will give a price. If everybody exits, 90% exits, matter is closed. So why have a bidding process unnecessary when promoter will already give one price and everybody is exiting? So that should be permitted. Okay, yeah. What is a fixed price? Like even in your ICDR, we have two methods, fixed price method and book building method. In fixed price, a fixed price is given, and in book building method, price band used to be given, bidding used to be done. In delisting, only this bidding process was given, fixed price method was not given. So now they introduced it. The acquirer shall offer a fixed delisting price, okay, which will be minimum above the floor price. So whatever the floor price has been decided, that is the cap base price which is decided, okay, by the merchant banker. Minimum he has to give a plus 50%, minimum 50% above the floor price he will give. Then if 90% are exiting, that means the promoter has completed his work, acquirer has done his job, because 90% are existing. It will be called as delisting is successful, and it can be done for frequently traded shares only. So if we go to see, earlier two options have been given for delisting. One is the reverse book building, which was always there, and now they have introduced fixed price method also, where above or 15% above the floor price we will give, and if 90% exit, it will be deemed to be allowed, and the rest everything is the same, that the acquirer must deposit 25% of the total consideration in a escrow account, and balance 75% will be done before the detailed public announcement. Means whatever price, promoter will have to keep funds from which everybody, whoever is selling that account, from that account all the purchases will be done. So 25% will be given, must be deposited of the total within 7 days of receiving shareholders approval, and balance will be given before the public announcement, 75% this. Okay, now floor price also they have said what will be the floor price. So he has to give 15% more than the floor price, right? So the minimum delisting price shall be highest of all these figures. Always, if the fixed price is to be made, then the fixed price must be at least 15% above the higher floor price. 90% of the people should be ready to be exiting. It can apply only to frequently traded shares, and it will be deemed that it is done. Okay, and then one point they have added for multiple regulations, okay, which is the same for all. They've added for amendment for buyback regulation, SAST takeover code, ICDR regulation. One amendment they've given which is common throughout, that whenever we are deciding the price, let's say in buyback price, in open offer price in takeover, in ICDR issue price, whenever we are deciding the price, and when they give you, you have to see the past 60 days, past 90 days, or when I look at the past prices, they said if there is any time period where there is an abnormal price movement due to the company, any news, that should be excluded. See, exclusion of abnormal price movement for price calculation. Common sense, we want to get the fair price. We want to get the fair price. That is why abnormal price movement should not be allowed. So SEBI allows exclusion of abnormal price movement, which is given under your regulation 30 sub-regulation 11, which talks about takeover, anything like that. Corporate announcement has happened, and because of it there is a major movement, those abnormal price movement should be excluded while calculating the prices. Simple, done. Okay, and then in SEBI LODR, they've added that the risk management committee, which is set up under regulation number 21 to assess the risk of the company and have some risk management policy in the company. They said that this risk management company should have 2 meetings. Okay, and the gap between the 2 meetings must not exceed 210 days. Means every risk management committee has to have meetings, and the maximum gap between 2 meetings must not exceed 210 days. Means within 210 days they need to have their next meeting. Simple. Okay, which is almost like, you could say, more than half year is also there. So at least in half year you meet is what they want to tell. That market rumors, now this is also one common thing that they've said, that if there is any rumors, like we saw in Adani, there were some rumors that they had done fraud, and nowadays any news channel comes, they bring some abnormal price movement. So now it is the duty of the top 250 listed companies to verify and confirm the market rumors within 24 hours. Okay, if the rumor causes a material price movement in their shares. So this is common, again they've said, is about rumor verification, that if any rumor has come in the news which is causing a material price movement, then they have to either confirm or deny and come out in the news and immediately confirm and do. So this is very important, so the market will come to know that the company is giving their side of clarification also, and this is for top 200 listed companies. Okay, with this we have completed all the major amendments that can possibly come in your examination. That's it. Thank you. I've shared it in the WhatsApp group. You can go and acquire it. Now we will start with our chapter wise revision. We will start, what is the plan? We will start lesson 1, 2. These are the 2 most important chapters. The rest all we can go faster on these chapters, okay, and complete it. We are targeting 3 hours to complete it by 5 p.m. Okay, so be with me, and I will cover only topics which are important from exam point of view. General topics I will not be doing, which do not come in the exam, or the general things will not come in the exam. Okay, so let's start with the revision. So the first one is your lesson number 1. Yeah, this is your basics of capital markets. So we'll target, if I complete it in half an hour, then we'll be able to complete all the chapters by 5. Clear till here? Okay, great. Let's start. Hi, so we start with the chapter lesson 1, which is called your basics of capital markets. Now in this chapter, when we understand the basics of capital market, they tell you what is a money market, which is actually short-term market where short-term securities are traded, mostly regulated by RBI. And the other one is your capital markets, okay, which is long-term instruments like your shares, debentures, etc., which is mainly the regulator is SEBI. Okay, so the two regulators are there. One, SEBI is for capital markets, money market is a RBI. Now from this chapter they tell you the basics, but later part some points come which come in the exam. We'll be discussing those points. Okay, so first is, what is a financial system? A financial system is a place where financial instruments are traded. Persons or people with surplus funds transfer their money to entities which require funds, who will in return give them surplus or gains. Okay, now as we saw your financial markets. Now your financial markets are money market where short term, that is up to 1 year, securities are issued, and capital markets are your long term securities like your debentures, equity, where it is issued for greater than 1 year. Now who are your market participants? Your market participants are brokers, and in your intermediaries there is a separate chapter that we will be doing. We'll come to know portfolio managers, depository participants, etc. And various instruments can be issued here: shares, debentures, bonds, etc. Now if you go to see, the Bombay Stock Exchange was incorporated, set up in 1875. Okay, it was founded in 1875, and your NSE was founded in your 1992. So NSE is a more newer stock exchange having more new features. Okay, now what is the function of any financial market? So the function of any financial market is to mobilize funds. What is the language? It is to mobilize funds. When I say mobilize, means move funds. And move funds from whom? Okay, from those who have excess capital to those who need capital. Okay, and this helps in converting your savings into investments. Simple. Okay, now just an idea, what is a money market? So money market is a market where short term instruments are traded. The regulator for money market is RBI, and here the issuers are normally governments, government bodies, etc., and some corporates also issue some short term instruments. They can also come here. Now why would it be here? Because if someone is in need, okay, of short term requirement of funds, they can go to the money market. Now when we come to capital markets is your stock market, as we know, where securities are issued by any regulator. It is for greater than 1 year. Long term instruments are coming. Now to know the health of any economy, if I want to know that what is the strength of an economy, we look at their stock markets. So if the stock market is healthy, we know the economy is doing well. When the stock market is crashing, we know that the economy is crashing. So there is one line, it is said that the capital market is treated as a barometer of the economy. Barometer means what? A yardstick, a threshold, a indicator of the economy's health. Okay, here in this market we have shares, debentures, bonds, etc., which are issued. Now as we've already done, what is the need? It is to mobilize the funds from those who need the money to those who have excess money, and the objective is to convert your savings into investments. And having in the capital market, there are so many types of instruments, so many companies that are there. So when an investor is investing, he can very well diversify his risk also, where he will put some in mutual funds, he will keep some in debt segment, he will come some in shares, he will keep some in gold. So that's a capital market opportunity that you get, which helps me diversify, and because of that I can mitigate my risk also. Okay, now we've already done this. What is the function of this? To mobilize the funds, convert your savings into investments, okay, etc. Now, so this we've done. Function of security market, capital market, anything is to convert your savings into investments and facilitate buying and selling of trading. Now we see in the market there are two other kinds of bifurcations. One is called as a primary market and the other one is called as a secondary market. Now let's understand the difference between the two. Okay. Now difference between primary market and secondary market. Whenever a company comes and issues a fresh securities, brand new securities are issued. So issue of fresh securities are called as primary market. Issue of fresh securities are called as primary market. So company issues it to the investors pays the money goes to the company. So when the company is issuing the shares, they will get the money. So it amounts to increase in capital of the company. So it is a capital raising for the company. Examples of primary market issues are, now you tell me, when securities are issued and company gets more money in IPO, FPO will also come because company again is issuing fresh securities to the public. So they only get the money. Even right issue will come here because company is issuing shares to their existing shareholders. Even ESOPs will come because company is issuing securities to its employees and money is coming in. So that's primary market. In secondary market, once the securities are issued, once the company is issued to the investor, now the investor had bought it at 100 and now the price is 150. So the investor wants to sell it off. He will sell it in a secondary market. When your securities are listed after the IPO, now trading is going on. This is called as trading and this is called as issue of securities. Okay, your money, if 100 rupees is there, he had bought at 100, he sold it at 150, the money will be given from the one investor to the other investor. So secondary market is a transfer of securities. It's a trading or transfer of securities from one investor to another investor, Concept clear? Here the company does not raise capital. Simple little points. Okay. So what is primary market? Primary market is selling of new securities. Okay. In primary market, who makes the issue? Always I told you the word that you will use is issue of securities. Okay. So company can issue, anyone can come, government can come, anyone, whoever is issuing. Even in money market, there is primary market and secondary market. When government issues shares or bonds or government securities, primary market. When the investor is selling to someone else, is called as secondary market. Let me give you a simple little second example. You have bought a house from the builder. So the builder gets money and you get the house. You are the first investor. It is a primary market. Now today you want to sell your house. You will sell to someone else. Now that is a secondary sale. Investor to another investor. Done. Okay. So how do you define secondary market? A secondary market is basically trading. I told you what the word I have told you to use. Trading of securities that have already been issued. And how do you sell it? Through brokers. Perfect, sir. Understood. Very, very nice. Okay. Primary market, secondary market I have told you. Yeah. So differences I've explained. You can nicely write it here. And just note that secondary market they have written your FPO, which is wrong. Okay. Don't write it here. It is FPO will come here when the company is issuing fresh securities in the market again. Okay. Now coming to regulatory framework. Now obviously your security markets will be regulated through multiple acts, and some of these acts we have as a chapters only, like SEBI Act we have a chapter, SCRA Act we will have, Depositories Act we have, and company law we have a separate subject only. So all these acts we will know what they are when we do the chapters also. So no need to do now. When we do those chapters, it will get clear. Now, need for regulators in the market. Now, need for regulators in stock markets. There have been a lot of malpractices that have happened in the past, which has amounted to loss of trust in the securities market. So, regulator is required, like SEBI, to protect the interest of investors, to develop the securities market, okay, and to protect us from any kind of malpractice, unfair trade practice, okay, which is there, and to ensure that there is a smooth functioning of the market and we can develop. So if you go to see earlier, when we had, now who is the regulator of stock markets? SEBI. SEBI is the regulator of stock markets. In 1992, this act was passed, and this became our regulator. Before the SEBI Act, we had the controller of capital markets. And the regulator name was controller. Now all this is gone. This act is gone. This regulator is gone. Now we have the new one. Simple. Okay, and SEBI became our regulator, and controller of capital issues was repealed, and this was introduced. SEBI Act was introduced. Now actually the chapter starts where they ask questions in the exams. Okay, so till now what we did was somewhere the basics, genuinely the basics, and now we start with the topics that can be asked in the exam. So question number 1, what is a QIB? What is a qualified institutional buyer? So if we see from the name itself, they are institutional buyers. So they are not retail buyers. Buyers in the market, okay, a buyer of securities could be two kinds. One is a retail buyer, okay. Retail buyer could be an individual, okay, like you, me are buying. So they are not covering us. The other one are called as institutional buyers. Sir, what are institutional buyers? Institutional buyers are like they are called as qualified institutional buyers. Is every institutional buyer a QIB? Answer is no. They have been qualified and they have been mentioned in the definition. So a list has been given. It's a closed list. Only those mentioned there are called as qualified institutional buyers. So institutional buyers could be a mutual fund, could be a pension fund, could be a government body. Okay, so they have given you a list. Only those are your institutional buyers. So let's see. Participants in capital markets, your QIB. So you think they will buy less or they will buy more? Obviously a QIB are there. They are institutional investments who buy shares on large scale. So they are institutional investors who buy shares on large scale. Okay, they are perceived to have more expertise, and they have financial proficiency to evaluate and invest in the capital markets. Mean they are capital market experts, so they will evaluate and invest in the capital markets. Next, institutions with a collective large group of people. They are usually institutions with a large group of people. Obviously in an institution you will not find one person. Now, does every single institution qualify to be a QIB? Answer is no. Only certain which SEBI has defined under regulation number 21SS. Okay, so regulation number 21SS has defined what is a QIB. So QIB consists of a closed list that comprises of these 13 people only. Okay, 13 people only, which we will read and complete. Mutual fund, venture. So you can just learn the list, how many ever we can do, and done. Mutual fund, venture capital fund, AIF, all these institutions will come later in a syllabus somewhere. Scheduled bank, public financial institutions, okay, any multilateral, bilateral institution, state industrial development corporation, insurance company, pension fund having minimum corpus 25 crores, pension fund of having minimum 25 crores, national investment fund, insurance. Now these three were added now recently. Okay, so we'll see insurance fund set up by the Army, Navy, Air Force, insurance fund set up by the Department of Post, and systematically important NBFCs. So all these three they are institutions and they have a lot of funds they invest. That's it. So 13 institutions have been categorized as qualified institutional buyers. So beautifully explained. Let's go to the next one. One of them, when we saw, they had mentioned foreign portfolio investor. Sir, who is foreign portfolio investor? Tell me. It has come here now. And now they have explained who is a foreign portfolio investors. This independent question can be asked in the exam. So this is your question number 2 that they can ask. Sir, what is a foreign portfolio investor? First, let me tell you the meaning. Now this I'm just generally telling you. Pay attention to this. Okay, so you'll understand the concept. There is a FPI and there is a concept of FDI. There is a foreign direct investment and there is a foreign portfolio investor. Now, when we are talking in respect to listed companies, FPI invest, okay, up to they invest not less than 10%. FPI will invest less than 10% in listed companies. So a FPI is an institution which is building its portfolio. Like how you have a portfolio of Reliance, Tata's, multiple, or a foreign institution must be there, foreign mutual fund. It is also building its portfolio. So it's from foreign building its portfolio and not less than 10%. Why, sir, less than 10%? Because if it is 10% or more, okay, or more of listed company, they are classified as FDI and different laws will apply. A consolidated FDI policy will apply. So we are concerned with FPI. Investment threshold, I have told you, they invest less than 10% in a listed company. Now FPI are classified into two categories. So there are two FPI, you understood? Yes. Now we are seeing two classes of categories of FPIs. So there are only two categories. I'll tell you the second one. It's very simple and I think you can also directly write it. Which is not falling under category 1. So this I believe you will never forget. That which is not falling under category 1 is in category 2. Simple. In category 1, they give you sophisticated groups, a little professional people who are maybe regulated, who have like government bodies, okay, like very professional institutions have been mentioned in category 1. Let's look at this and close it. Okay, so who is a foreign portfolio investor? A foreign portfolio investor is registered under chapter 2 of the FPI regulations 2019. So first we can write that FPI means a person who is registered under chapter 2 of the FPI regulations 2019. Second, categories of FPI. How many categories of FPI are there? 3 categories or 2 categories. 2 categories of FPI. The first category is investing in government body. Now just learn the categories. Government and government related investors, pension funds, university funds. Now appropriately regulated entities means any entity which is regulated by any regulator is a appropriately regulated entities, such as insurance, because there is a regulator, right? Asset management company, there is a separate regulator. Investment manager, investment advisor, all of them are category 1. Then they say entities from Financial Action Task Force which are appropriately regulated. Now we are seeing entities which are from other countries but which are following the money laundering laws. They are following the Financial Action Task Force laws and they are appropriately regulated. So Indian are also covered and foreign are also covered. Okay, here Here is mainly foreign portfolio investors only they're talking about. Appropriately regulated and other categories they are covered. Means you might not be appropriately regulated like an insurance, assets. So finance, apart from finance they are covering, or foreign. Next is entities which are under the financial action task, which are compliant, which are member countries of those countries which are following the FAFT. Okay, FATF. If you are unregulated but your investment manager is properly regulated, still you will come here. So either the entity is regulated, appropriately regulated, or which is unregulated but the manager is appropriately regulated, or any other university in existence for more than 5 years. We just have to learn the list. Okay, an entity whose investment, now understand one thing, that if the investment manager is in category 1 and having a FPI license, or if an investment is made in this company A and this entity who has majority shares is in category 1 license they have got, so even company A will automatically become category 1 FPI. So what? Two conditions they've given you. If the investment advisor, if the investment manager who is appointed in company A has a license, then even the where he is appointed, that company also will be under category 1. If one company is owned by another company and the holding company is another company which is having category 1 license, so the subsidiary also becomes a category 1 FPI. Let's see. An entity whose manager is registered under category 1, so even that entity will become category 1 FPI. Second, if one company has at least 75, if an entity whose 75% is owned by another company which also has the license of FPI, it is allowed. So again, few points is there, we have to learn and done. So what is it? 5 categories they have given you. Government pension fund appropriately regulated entities such as they've given, such as insurance, asset management, all these financial are given. Then other entities which are appropriately regulated. If it is unregulated, at least their manager should be regulated. University and any entity in which investment advisor has a finance FPI license 1, or it is owned by another company which has FPI license 1, then this entity is also under category 1. Very, very simple. Now we see your category 2. Sir, category 2, so appropriately regulated, not coming under category 1. So at least this I know. And then all the other categories they've given, you see these are not in category 1. Like endowment foundation, charitable, corporate bodies, family offices, individuals, okay, unregulated LLPs, etc. Appropriately regulated entities on behalf of their clients as specified by the board, etc. Okay, not following. So very simple, 5 entities: government, pension, university, appropriately regulated entities which are from financial action task force member countries which are appropriately regulated, or at least their manager is appropriately regulated, or university having more than 5 years of existence, an entity in which investment advisor or their holding company is having of FPI license. All of them are under category 1, and all the under category 2 are others: charitable, family offices, endowment foundations, etc., corporate bodies, etc. Okay, now we come to another which can come as a separate question in your exam. So we'll write your question number 3. Okay, what is question number 3? Is AIF. What is alternate investment fund? So it is a alternative way, okay, then going to your traditional market. Normally when you go to the traditional method is taking a bank loan. AIF funds is a fund created where they invest in the concept of high risk, high return. So first thing is, what is AIF regulation? You will write it is defined in your regulation 21B of your SEBI AIF regulations 2012. So what is AIF? It is defined under regulation 21B of AIF regulations 2012. Now, what is this AIF? So this is, let me explain the concept. So we have a fund, okay, which is called as AIF fund. This AIF fund privately pools means there is no public announcement, no public offer, privately given to high net worth individuals. It is issued. When I say high net worth individuals, means what? Here these people in AIF, the investors in AIF have to invest at least 1 crore rupees. So how much they invest? At least 1 crore is the minimum investment amount. So they will invest in startup companies, in all those companies. Mainly they invest in early stage companies. Okay, the investee company in which the AIF will make an investment called as an investee company is a early stage company. So why will anyone invest in an early stage company? Because this early stage company might have the potential of high risk is there, no doubt, but we also know that with high risk sometimes there is high return also. So this is the concept. Now AIF when are of 3 categories. How many categories? Category 1, category 2, category 3 categories. But at least tell me which year it is. AIF regulations. AIF regulation is of which year? 2012. Okay, and the definition is given under which regulation number? 21B. Okay, so definition defined under regulation 21B. This much we can write. Category 1 invest in startups which are and invest in social ventures, anything which is good for the society, that they will invest in angel funds. Invest in extremely start, like how we had venture capital. I don't know whether you know what is venture capital. So venture capital used to invest in this really seed funding they used to give. The early stages used to come from VC. Now VCs is called as angel funds here. Okay, VC angel funds are here where they invest. They are like an angel has come, funded your business. So they all will come here. Category 3 invest in hedge funds. Hedge funds, what do you mean by hedge funds? They invest in complex trading strategies. Okay, like your derivatives, etc. And category 2 are which are not falling under category 1 or 3. Simple. Okay, so let's move ahead. And obviously it is a fund just like mutual fund. Okay, mutual fund also pools in money and then invest as per the defined terminology. Here they will also privately pool in money. Mutual funds make a public issue. Here they can't make public issue. They will privately pool it and then invest as per the categories whichever they are there. So obviously AIF has a separate regulation, so they will not come under mutual fund regulation, CIS regulation, because they are different regulation. This is a different regulation. Okay, that is one thing. And second, if I go to see another point of AIF is AIF could be built in the form of a trust, company, LLP, anything. So any structure can be made to give effect to this AIF. Let's see. Very simple. I've covered everything. Now we'll just tick and finish it off. AIF regulation is defined under regulation 21B. What does it say? It's a privately pooled fund and it can be in the form of a trust, company, body corporate, LLP. Okay, and which are not coming under any other regulator or any other thing. Okay, which are not covered under mutual funds, CIS or any other regulations. Now they've just given us separate exclusion also, that listen, the following are not AIF fund. So when they say it's a negative list, like all this is separate. There is a separate law for all of this. That's why it's not coming here. Like ESOPs, employee welfare funds, family trust, they are all separate and as a separate concept. This I told is a separate concept altogether. Okay, securitization company, holding company are not AIF. Simple. So how many categories? I have already told you. So there are 3 categories. This is invest in VCs. What did I tell you? VC is called as angel funds. VC invest in early stage startup companies which have a potential of high growth. Category 3 is your hedge funds, and category 2, which is not following here and there. Example, you will see private equity and debt funds. Private equity and debt funds are not following in either 1 or 3. So they've given you an example. Private equity comes here. What is private equity? I'll tell you later. Okay, when it comes, concept will come. So this is it. Your 3 categories are there, which is done. Now we see, I told you venture capital. What is a venture capital? Very similar to angel fund, which will come later. This is just a concept they've given you. Angel fund is basically a venture capital is like that category 1 of AIF, okay, where they invest in innovative companies where they are in the early stage, okay, and they are normally private companies in which they are investing. Why do they invest? Because they have a high risk, high return. It is a resource of they want to. So basically, when they give this fund, they support innovation, knowledge based idea, technology, etc. So venture capital fund, I told you it comes under which category? You will write it is a alternative investment fund coming under category 1, which invests primarily in unlisted companies. Okay, startups, early stage companies, mainly involved in new products, new services, new technology, having some intellectual property or a new business model shall be included a angel fund. I told you what now we more famously call it as angel fund. Angel fund venture capital fund is more or less the same. Okay, so the venture capital fund, they group all the privately pool all the investors and then invest in early stage companies, high growth companies. Okay, now nowadays what is happening is companies can pick and choose, like VC also there are different kinds of VCs. So when I see a VC for education might be a different set of VC firms, like how we have companies, but every company has their own specialization. Similarly, VCs also come, and some VCs invest only in medical products, some VCs invest only in electronic, some will invest only in fintech, some will invest only in crypto. So there are different VC groups targeting different kinds of investments. Now we had done one word which was called as private equity, okay, which I told I'll do it later. Now let's see the concept of private equity. So this is another question that can come in your exam. What is the meaning of the term private equity? Okay, let me explain. Very easy. If you understand the concept, you can build it. So private equity is a fund, just like how VC, they have pooled money. But when you break down the words, so you will understand. They invest in equity, means they will invest in equity shares of private companies. Concept over. So a private equity invest, they will study all the private companies, they will find good companies, invest in them. So they are called as private equity. So they invest in equity shares of private companies. Now if they invest in an equity shares of private company, you think they can easily sell it? Today, it's easy to sell shares of a listed company or easy to sell shares of private company? Obviously listed company is easier. So your investment made is generally illiquid. It's not easy to liquidate or sell the thing. They make an investment document. The investor comes in. The investor comes in, makes an investment document, invest in the private company. The private company will issue equity shares. They will give the consideration in return. That's it. Okay, and this consideration could be in the form of equity shares. Sometimes they also give debt. Okay, like is a type of equity finance, one who makes securities in not publicly traded companies. Private companies invest in some asset which isn't publicly traded. Private equity comes from high net worth individuals. Now you tell me, if I give you money 1 lakh rupees to invest, will you invest in stock market and listed companies, or you invest in a private company? No person will ever invest in private company. It is only HNIs who have expertise to invest in these things. So generally they are illiquid, but they still invested with the opportunity of getting high returns. Clear? So accredited investors etc. can invest here. Accredited investors are super rich investors. Okay, the really high, even richer than HNI. Okay, so if I take all the rich people and then I classify Mukesh Ambani and others, so then that is accredited investors. Now when we see types of private equity, very simple. From the name, leverage buyout means they will take a loan and then invest. So the investment will come, we will take a loan and then invest. So it's a leveraged buyout. So when purchase of the equity shares is done through debt using financial leverage, it is called as leverage buyout. Simple. Venture capital we are done, it's investing in a private equity, okay, in less mature companies which are in early stage or they are looking for expansion. Growth capital, private equity could also invest in companies which are looking to expand into newer markets or launch newer products. Simple. So privately we give to anyone. We take a loan and give, it's a leverage buyout. We give it to a less mature company and early development or finance is there, and growth capital is just to move ahead. Okay. Now we come to the important thing which I always used to tell you that, you know, this is there, is important, can come in your exam also, which is called as angel fund. So angel fund, again I told you there are three categories of AIF. Three categories of AIF. Okay, three categories of AIF. So what is it? Category 1, 2, 3. 1, 2, 3. Category 1 is, it is socially and economically viable to India, to country. Therefore, certain relaxations are given. Relaxations given by SEBI. So normally where we tell others that you have these rules, for category 1 we give benefit. One of the type of category 1 is called as angel funds. Now angel fund is a kind of fund, pay attention. So this is a angel fund. It is which category? It is a category 1 AIF. What do? They pool money, they privately pool money from angel investors. Angel investors. So who are angel investors? Angel investors invest in early stage companies. In they know that the money from here will go in startup companies, startup or early ventures. That's it. Concept done. Let's see. So you have to write what all you need to write. First, it pools money, privately pools money from HNIs, okay, to invest in startup companies. Okay, they are coming under category 1 AIF, and they raise funds from angel investors. Who's an angel investor? They are affluent individuals, okay, looking to provide capital for business startups. So they invest in earliest equity investment. So the earliest equity investment will be made by them, and they shape and fund the business. Now we come to another category. Which is called as anchor investor. Another part they've said is anchor investor. Let's see what they are. Okay. So now we are seeing the concept of anchor investor. So anchor investors are QIBs. Who are they? They are a qualified institutional buyers who invest at least 10 crore rupees in main board or 2 crore rupees in SME board. So these two I want you to learn. What is an anchor investor? Anchor investor is a QIB which invests 10 crores in main board, that is NSE, BSE, or 2 crores in SME stock exchange. Done. Okay. Now the company wants, they can tap such big investors who are bringing in 10 crores into this. So it is allotted to them on discretionary basis. I mean, the company can allot to such big players if they want. If the issue is on main board, a limit has been given, and for SME board they have given a separate limit. So the thresholds, you can just see it from here, learn it. This is the latest thresholds. See, let's see, okay, that now what are we saying, that we are issuing it to anchor investors. Now, these are a big sophisticated group of QIBs. If the allocation is up to 10 crores, we have to get minimum 2 anchor investors. Means if we are allocating to XYZ person to a anchor investors, we are getting all these sophisticated, minimum maximum 2 we have to get. Okay, maximum 2 if it is up till 10 crores. If it is more than 10, then obviously I require more such investors, so it will be minimum 2, maximum 15, and minimum every time they have to pay 5 crore rupees. If it is more than 250 crores, then minimum 5, maximum 15, and for additional 10 crores, such investors for additional 250 crores or part thereof. So normally 10 to 15, and for every 250 crores rupees, I have to get 10 people more. Clear? So you can take a screenshot, write it down. Similar points have been given for SME exchange. Okay, SME exchange. So allocation is up till 2 crores, we can get maximum 2. Okay, then 2, 15, 15, and minimum 5, 15. So this number is given, you have to learn. Now what is it? Now what is the main rule about anchor investors? Let's understand here. We're trying to understand what it is if it's a anchor investor. So if anchor investor is there, tell me, do you want money from anchor investors? Answer is yes, they are getting so much money, my headache gets solved. So for them, we have a separate line. One day before they come, bidding for them is open one day, and on that day only we complete the allotment. And the allotment is also completed on the same day. Shares are allotted on the same day, and it is locked in for a period of 30 days. So again, bidding for anchor investors starts one day prior. Okay, and it shall be completed on the day of the bidding. Allotment is completed on the day of the bidding, and it is locked in for a period of 30 days. Now, 60% of the QIB portion shall be available for anchor investors. See, whatever is the QIB, 60% of that, up to 60% of the QIB portion should be available for anchor investors, and 1/3 of the anchor investor portion should go to domestic mutual funds. So if this is the QIB portion is 100 crores, 60% of the QIB, that is 60 crores, will go to anchor investor. How much is the anchor investor portion? 60 crores. So 1/3 of the anchor investor portion will be given to domestic mutual funds. That's it. Okay, that is 20. You can take a screenshot just to understand. The figures are clear. We can move ahead. Now high net worth individual, just a terminology, it's just a term. What does high net worth individual mean? So high net worth persons is a class of persons distinguished from retail in segment. So first we'll say retail investors are different and HNIs are different. Ambani is different and normal person is different. So when they say they are different means what? So they have a individuals having over 2 crores investable surplus. Okay, can be considered as HNI. Means they are having investable surplus. They have so much money to invest in the market, that is 2 crore rupees. So they are HNI. If they are having from 25 lakhs to crores, they will be called as emerging HNI. So 25 lakhs to 2 crores will be called as emerging. So 2 crores is HNI, 25 lakhs to 2 crores is emerging as a HNI. Okay, so these HNIs can invest. Similarly, when we just look at pension fund. So for pension, if you've seen, the employer also gives, it's a fund. All your pensions which are there. Okay, let's say if pension is to be given to a government employee. So every month some amount is deducted from him, some amount is deducted from the employer. If you know how pension fund works. So if you're working in the government job, it's a very good thing. Okay, so government transfers some amount and the employee also transfers some amount. Even private companies can offer some scheme to the particular employee to give pension. So employer will give some amount and some amount the employee will give. All this money goes to pension fund. Pension fund is regulated by the Pension Fund Regulatory Development Authority. This is the regulator. Okay, these pension funds also have so much funds, they invest in market, etc., and they will give pension on the date of retirement. Done. So what is a pension fund? Let's close it. is a fund established by the employer, obviously employer will do, to organize the investments of the employees' retirement funds. It is money from here is contributed by both. It is a common asset pool to generate stable income over a period of time. Okay, and nowadays a government has Atal National Scheme, etc. So they are also there, these schemes, or even private companies can set up. So pension fund play a huge role in economy because they have so much funds, they can invest in stock markets, etc. They help in developing the Indian equity market as well. Okay, so we have all of this. Pension fund could be formal or informal. Informal is a for unorganized schemes, and for organized it is government pensions, voluntary pensions which are regulated under an act. Other than that also, someone unorganized sector come in, they are coming in category 2, formal, informal. Now this is there very simple, which I don't think they'll ask you. Equity shares, we know what it is. The capital market instruments, equity, preference, debentures, we've been doing from childhood. I don't expect them to ask. Okay, section 43 said there are two classes of capital instruments: equity shares Now from this equity shares, only one I wanted to know, which is differential voting rights. They ask in the exam. Okay, they ask in the exam which is differential voting rights. Now what is that? DVRs. So first thing is, a company can issue differential voting rights. Okay, it comes under section 43. Okay, and it says the provisions are very simple. I can break it down into three. If a company wants to issue differential like shares having different voting rights, first article should allow. Second, the maximum they can issue, now this is important, is shall not be exceed 24% of the voting power. So we can't issue differential voting rights exceeding 74%. 75 means alone one person will pass a special resolution. So many as it is DVR should not be issued. So maximum we can issue is 74%. So total voting power with DVR should not be exceeding 74%. This ratio will you remember. The third is, in order to pass this you require an ordinary resolution. And last is, company should not have defaulted in anything: filing returns, deposits, debentures, term loans, all of this, etc. Preference shares, we know it's given under your section 55. Okay, to issue preference shares are those shares which have a preference at the time of dividend or winding up. Then we come to debentures. Now in company law we always know what are debentures. Debentures is given under section 2 subsection 30, which is about evidencing debt. Okay, types of debentures, bonds are given. Now remember one thing, that this is there which is covered in your securities, your FCCB, FCEB. Okay, very important, bonds and its type. So remember, bond is a type of debt capital where you get interest and you get fixed income security. So there is a called as a fixed income securities. So bonds is a type of debt capital on which interest is paid on the principal amount and the investor gets regular fixed income. Now obviously there are government bonds, corporate bonds, these are simple, but what we need to know important is FCCB, foreign currency convertible bond. Now I'll teach you a technique, you will know it very easily. These bonds are issued out of India. So you want, you can write it down with me. So these bonds are issued out of India. Okay, that's why it will be first in foreign currency. So these are denominated in foreign currency. And it is issued out of India by Indian companies. So Indian company is the issuer. And the investor could be a foreigner. So therefore, for foreigner, if I'm getting myself listed on stock exchange out of India, okay, issuing some bonds out of India, so it will be in foreign currency. Second, as we have a bond, as it is a bond, means you will get principal and interest will be paid. Third, these could be convertible. Convertible, as we know, na, convertible debentures. This is a convertible bond. It will be converted into the equity shares of the Indian issuing company. So 3 points I get from here only. Indian issuing company. Okay, so bonds, and one last point is, since it's a bond, it will be principal, interest, convertible, etc. Okay, and it is issued to foreigners by Overseas Depository Bank. It is issued by Indian company, but ultimately when the foreigner will not come to the Indian company to buy, he will buy it from the Overseas Depository Bank. Sir, why overseas? Common sense, na? As we have a depository in India, abroad there is a depository depository. The investor will have an account there with them, and from there he will buy. Done. These points you write, more than enough. Okay. So if you see, same thing is for FCEB. Sir, what is FCEB? Again, Indian company issuing this bond abroad. So you will get, it's a bond, right? It is a bond. So you'll get principal, interest. This is the first point. Second point, it is issued abroad by the Indian issuing company. So it will be foreign currency. Third, you can say it is issued by a overseas depository bank, because obviously they will, the foreigner will buy from the depository there. And only one difference is there. It is called as exchangeable, where if the investor converts these bonds, you will not get shares of the issuer company, but you will get shares of the issuer company's group company, issuer's group company, any other company called as offered company. So on conversion, you get shares of the offered company, not of the issuing company. Okay. Then similarly is IDR. Sir, what is IDR? Indian Depository Receipts. Very, very simple. Standard Chartered had done this. Standard Chartered is a foreign company. They wanted to get listed in India. So they have got listed on NSE, BSE. If you want to buy, you can buy shares of Standard Chartered. So you will buy through a domestic depository. Yes or no? You will buy through a domestic depository. Right? If I want to buy shares, it shows that you're owning shares of a foreign company. And since we are buying, it will be in Indian rupees. It will be denominated in rupees because we are buying, and created by a domestic depository. Finish. And it will enable foreign company to raise funds. It will raise foreign companies to raise funds in India. Simple. These points we write, more than enough. Derivatives. Remember, derivatives I have taken a separate sums part. If you do that, everything gets covered there. And sums you need to do before the exams. At least 1 hour dedicate for sums, 10 marks comes in your pocket. I have covered it in the dream batch. You can study it from there. I have beautifully explained derivatives, etc. Now understand the concept of REITs. What are REITs? Real Estate Investment Trust. Now a REIT is basically a trust which pools in the money from investors, just like mutual fund, AIF, etc. And only difference is they will invest in real estate. Okay. So they also collectively invest. REITs are mandatorily to be listed. There is no REITs in India which is unlisted. They have to be listed. Now once you are listed, okay, you are listed. So let me explain the concept. Okay, quickly let me finish. So I'll finish. Not only REITs, InvITs will also get over. So a REIT is opened. It is formed in the form of a trust. Okay, REITs is opened. Investors, so they are listed companies. Okay, so they are listed companies. Embassy Park is an example of REITs. Embassy Park is an example of REITs. It's a which has been issued. Investors will pool in money here into this REITs, and after that, this REITs will invest in real estate assets. What do these real estate mean? They will invest in income generating properties. So for example, they will buy commercial property. They will buy They will buy offices. Okay. They will buy malls. They will buy any other real estate asset. Okay. Etc. will be bought. Warehouses will be bought. From your income will be generated in the form of rent. Right? So you can either get rent or you can get capital gains when it is sold, the real estate is sold. So all the money is to be distributed in the form of dividend. So 90% of the income of the real estate investment trust is distributed as dividend. So whatever we get on a regular basis, so this REITs will then give dividends to the investors. Same concept if it would invest not in real estate but in infra projects like roads, you're building any railway line and getting money from that, then it will be called as InvIT. Same concept, done. Let's see. So it is just like mutual fund. It's a collective investment scheme which pools money in income generating real estate. Please learn the word so you will be able to write it. Income generating real estate. Simple. Okay. It invests in portfolio of real estate. What's the benefit? People will be able to invest in real estate. It requires less capital as real estate would invest so much money. Here it is suitable for small investors. You get assured dividend because 90% of the money has to be divided as dividend. Normally, a lot of tax benefits are given. Capital appreciation means your money can be growing faster. Same points you have to write. Just write that they invest in infrastructure projects. Rest everything is the same. Okay, then we come to a concept of muni bonds. So these are muni bonds are issued by municipal bodies and government bodies. Okay, Bangalore municipal body was the first urban body. So the government issues to build roads, etc., and they pay interest. So whenever you see bonds, please mention principal, interest, fixed income securities, etc. Now why the government issues? For raising money for certain projects. Now, one small little point they've given for securitized debt instruments. What is a securitized debt instrument? So, simple point is understand a securitization company. Now, what it is, you don't have to get into that. A securitization company which purchases debtors or purchases, they purchase mortgages from banks. So let's say if a mortgage is there created, bank knows that they're going to get regular inflow from the borrower. Bank says that I want to sell it off, so it is bought by securitization companies. Once securitization company gets this, they will issue it in the form of securities to the people. They'll break it down and they'll tell that whenever this borrower will give, I will further give you all interest on it. Okay, so what is it? It is issued by securitization company. These are mortgage backed instruments, means ultimately when the security, so if I am buying a SDI, I am buying a security debt instrument, I will know that it is issued by a securitization company which has purchased it, the mortgages from a bank. So as the borrower would have paid the bank, he will pay the securitization company who will further pay me my interest amount. So it is a safe, secure, since it is backed by mortgages. Okay, and it helps the bank liquidate their debtors also. Okay, with this we complete our lesson 1, all the important topics. Thank you. Now we start with your lesson 2. Remember one thing, that by 5:30 max you have to finish your part A. And then you are sorted. Okay, so important chapters it is first and second. That's why I'm going a bit slow. Then I will take you all through quickly and finish the part A. 5:30 you finish it, or maybe 5, and then you can take extra time, and then after that you have till 11 o'clock or 10:30 or whatever time you can complete your part B chapters. Okay, so we'll just take a 2-minute break. You can read through, just browse through the topics, and then we will start. Hi guys, in the chat box, can I quickly have that I'm audible, visible? Okay, and someone has asked whether this will be sufficient. Obviously, whatever chapters I'm taking, I'm knocking it off. That will be sufficient because I'm covering everything. Okay, and all the important exam point of view. So you can stick. I'm also going to cover, a lot of stuff, and then I will leave you all to complete other things. I'll guide you also. So quickly, if I can have chat box, in the chat box, I'm audible, visible. So I'll start and complete the balance part. Okay. So we are first targeting part A, all the 7 chapters to complete by 5 p.m. Once we do that, we'll be in a very strong position to complete the full portion syllabus. Okay, quickly in the chat box, I need from you all, I need that assistance from you all, that you all be responsive. Okay, am I audible, visible quickly so I can start? Please be responsive. If others are not messaging, you take their responsibility. Go ahead and mention that I'm audible, visible. Okay, quickly. Chalo, let's start. Hi, so we start with your lesson called as secondary market in India. So what do you mean by secondary market? The secondary market is investor to investor sale. When the shares are already issued to the investor, now the investor will be thinking where to sell the shares, to whom to sell. Obviously, he sells it on the stock market. That is called as your secondary market in India. Okay. Now they go on to tell you the development of the stock market, that it was first an association of brokers. Then they said that we will demutualize it because mutually it was owned by the brokers. Then they demutualized it and made it into a company called as a corporatization. And now we don't have NSE, we have NSE Limited and BSE Limited. Simple. Now, what is a stock exchange? A stock exchange is a place where securities are bought and sold. It is a body corporate, okay, and registered and set up under the SCRA Act. Simple. Role of a stock exchange, not that important. Okay, the role of a stock exchange is to develop the market, allow mobilization of savings into investment, give a secure platform, protect the investors. It acts as a barometer of the economy. So a stock market, if I see of any country, I can make out the health of the country. Let's go to important things. So you have this in 1875 and this was founded in 1992. Let's see, we'll go to something which is important now. So one thing they have told is called as dematerialization. Remember, what do you mean by the term dematerialization? It means online trading. Now, can a company issue shares in physical share certificates? Okay, so here for your listed company, it has been completely banned to issue physical share certificates as a issue. Okay, so here remember two regulations, regulation number 40 and regulation number 29A or 9A of SEBI Prospectus and Allotment of Securities Rules 2014. Now pay attention. Regulation number 40 is saying that every listed company has to issue shares in demat form only. So please note it down. The first important thing from this chapter is that regulation number 40 says that every listed company has to issue securities only in demat form. Another amendment was there in rule 9 where they have said that every unlisted public company shall issue securities only in dematerialization form for Companies Act also. So in LODR also regulation number 40 was there, and now rule 9A saying that unlisted public companies have to issue only in dematerialization form. So then which leaves out to private companies, then we are left with private companies. So in 9B, that was 9A that we said that public companies have to issue in demat form. So if you go to see, there is listed rule 9A, rule 9B, okay, and then we have your Regulation 40. Regulation 40 says listed companies have to have only in demat form. Rule 9b says unlisted public companies have to be in demat form, and 9b is covering private companies. Now let's see which are private companies, how they have to issue. So every private company which is not a small company. So small companies don't have to comply with this, but other than a small company means anything which is a big company, every private company shall also ensure that all their shares are in dematerialized form from September 2024. Okay, so all the new issuances, transactions will be done in demat form only. So even private company, only one exception is there who don't have to do, that is a small company. So small company, when their thresholds have exceeded, then they have to dematerialize within 18 months. So for all companies other than a private company which would qualify as a small company, they should dematerialize within 18 months in the year when they no longer qualify to be a small company. So small company do not have to dematerialize their shares, they can still issue in physical form, but the day they cross the threshold and they are no longer classified as small company, they have to mandatorily demat their shares within 18 months. So listed companies compulsory demat, publicly unlisted compulsory demat, private company compulsory demat, only small company is exempted. Simple. Okay, now let's get into something which is important. Market intermediaries, which is there, we will have a separate chapter only, so no need to read on that. Now one concept they can ask you, small concepts are there, which is called as exchange traded funds. Now what is a exchange traded fund? It is a kind of a fund, which tracks a index, For example, Nifty is an index, Nifty 50 is an index, gold pricing is an index. So whatever price happens there, the fund will increase accordingly. So let me explain that this is nothing but a index fund. So if I would have bought Nifty, then whatever pricing is increasing in Nifty, whatever percentage is there, that much will be mine. So they make a replica of a fund. They make a replica of any index. So if I take gold bees, then they will track the gold prices. How much ever gold prices is there, that much the fund will give me. So why any investor would buy a exchange traded fund? Because they track the performance of an index. Okay. Unlike regular mutual funds, which invest in shares, they do not invest in shares. They invest in a index and they match the index. Derivative, there is a separate sum list I have made on derivative, futures, etc. is covered. Okay. Options is also covered. Now, this they talk about right issue. Okay, this they talk about right issue, which I don't think is very important. Right issue, we know. Right issue is equity shares or securities issued to existing shareholders. So whenever we issue to existing shareholders, it is called as right issue. Clear? It is given under your section 62(1)(a). It is given in your section 62(1)(a). Now, what it is said, pay attention, that a company can, to its existing shareholders, they can give certain rights. So rights to buy equity shares, rights to purchase at predetermined prices. Predetermined means what? At some discount they will get to buy. Now imagine if someone gives you a discount to buy something, will you buy? If you don't need it, you will not buy, na? So the investor has two options. Okay, he has two options. Either he will exercise the option. He's got a discounted price, discount coupon, etc. So you can choose. So for example, if any of our students have got a dream batch, so in dream batch they get a 1000 rupees off coupon, discount coupon. So this is like a rights that they have got. Now this rights, okay, two options they get. One is they can choose to exercise the right, then they will get the discount. However, if they didn't like the rights, then they can transfer the rights. Okay, so there are entitlements which is there. They will say that, listen, I'm going to get a benefit of 1,000. I will sell it off to someone for 200, and that other person will get 800 benefit. I will get 200 benefit. So both can be done. Okay, simple that they said. I can give full rights. I can exercise full. I can exercise half, etc. is what they have given. Options available to the equity shareholders. So either they can go for the full thing, okay, or they can apply for part of that, or they can choose to renounce it, that they don't want it at all, or they can renounce only a part of it. Very simple. Okay, so nothing legal. And if they want renunciation of the right entitlements, whatever rights they get, nowadays broking apps are giving you options, so then you can do it and sell those rights through your broking app, or you can sell it through a off-market transaction, speaking to anyone else. That is off-market means what? Over the counter sale. You meet someone, you have an agreement and you sell it. That is also allowed. Now, coming to main board, okay, main board, subordinate board, etc. Now, main board is your NSE, BSE. Your subordinate boards are other boards, other stock exchanges. Now, pay attention to the concept, so it will be easy. Now, in your stock market, below NSE, BSE, they have made BSE SME and NSE SME. Okay. So today we know listed companies means they are listed on NSE, BSE. Okay, for this ICDR regulation is there, ICDR regulation 2018. Now little bit we will be doing ICDR also now, but there is a separate chapter on ICDR, so that you can do it from there only. The thresholds for listing, etc. Now for SME also they have given you. SME means a small and medium exchange. BSE SME and NSE SME. NSE SME is called as emerge. We'll see what is the thresholds. Then there is a concept called as Innovators Growth Platform. So your tech companies which are there, they can get listed here, okay, and their securities will be traded. And social stock exchange is for NGOs. NGOs normally they go through Keto or they go through these crowdfunding platform to raise money. Now they will say that government said, why these NGOs also should be allowed to raise money. People should be allowed to give donation. So this is important. Huh? This has been newly introduced. So NGO was there. So they said that this social stock exchange can issue zero coupon, zero principal bond. So what is zero coupon, zero principal bond? So in this what will happen is this a social enterprise which is like an NGO will get listed on the social stock exchange. They will issue the security called as zero coupon, zero interest bond. So if I buy, I will get zero coupon, I will get zero principal. That means it's a donation only, na? And the money of this will mandatorily be used for certain charitable objectives. Done. NSE, BSE. Now for your, you can remember the SME platform, BSE SME, and for NSE they have the NSE emerge. So the paid up capital should not be more than 25 crores. Asset they have given is maximum 1.5 crores net tangible. Track record should be of at least 3 years. Profit, positive cash flow should be there. So this you can read up, and this part is important here. NSE, this we can remember, very simple. Also we are seeing the thresholds for main board. So you will learn in your ICDR only. Here you can remember that the post issued capital means if you are on SME, then you are small, na? You cannot be more than 25 crores. If you are more than 25 crores, you will be compulsorily migrated to the main board. Minimum number of allottees is 50. Okay, IPO underwriting. Now 100% should be underwritten. 100% should be underwritten, means underwriter should be appointed. IPO application size. Now tell me which is more risky, to invest in SME or to invest in main board. To invest in Tata is more risky, to invest in a new small medium enterprise. Obviously, the government, in order to protect the retail investors, they have kept the application size expensive. They said application size should be 1 lakh rupees. Only then you can come in SME, because it's high risk. We don't want people to come in unnecessarily unless they know what they're doing. So in your application price in BSc, NSE, BSc is your 10,000 to 15,000. Reports will be given half yearly. Here it will be given quarterly. Market making is mandatory. Here it is not mandatory. Market making means what? If someone wants to sell and there is no buyer, the broker will stand as a buyer. Okay, so that is, in Tata's you'll always find a buyer, but in small SME you might not find a buyer. Done. Okay, innovators growth platform. I told you what is innovators growth platform. You can mark it as important. You can mark it as important also. Innovators growth platform. Can a manufacturing company come here? Answer is no. Sir, why? Because only companies with intensive use of technology, information technology, intellectual property, data analytics, biotechnology, nanotechnology can come and get listed on the innovators growth platform. It comes in your regulation 283 of the ICDR 2018. As on date, okay, 25% of the post issued capital should be held at least 2 years, should be held by. So to get listed, at least 25, so you should have got funding from some of the companies. So 25% of the pre-issue. So in order to get listed and to file a draft offer document with SEBI or offer document, the 25% of the pre-issue should be held at least for 2 years from a QIB or family trust or accredited investor or any of the following categories. Means a proper high level person has invested in it and this company is into using extensive use of technology, information technology, intellectual property. So we know that this is a innovation is going to happen here. So that is why they have made up a innovation growth platform. Okay. Now allotment. Okay. The allotment to anchor institutional investors as well as non shall be on proportionate basis. Yeah. Simple. So this much we remember is enough. Now we come to the next stock exchange, which is called a social stock exchange. Sir, what is a social stock exchange? It is basically inserted under your chapter 10A of the ICDR regulation, which says that a company with a social intent, so we call it as social enterprise, a social enterprise which has a charitable intention, they can set up for raising funds. So this social stock exchange has been set up to raise funds. They are called as a social enterprise. They will get listed, they will raise funds, the investors will get zero coupon, zero principal back, means they are giving charity only. Okay, so now eligibility for a social enterprise. So even Tata's could, NGO could also come which has a social intent, definite social intent, or even a profit making company, which wants to have a side project to help the government because they have CSR funds, etc. They want to raise money also. Tatas can also do this. So these provisions of chapter 10A apply to a non-profit company seeking to get registered with the social stock exchange, or not-for-profit company to get raise money. So one is just to get listed, the other one is listed and raise funds. Obviously the second one is going to be more normal. And profit social enterprises can also come if they are identified as a social enterprise. So even Tatas can come here. Okay. Now for any company to be called as a social enterprise should have a social intent. Now someone says, sir, what do you mean by social intent? Means at least one of the following activities they should be doing: eradicating hunger, okay, healthcare, education, gender equality, environmental, national heritage, rural sport, incubators, okay, livelihood of the rural, urban, poor people, disaster management, promotion of financial inclusion, disadvantages community, remove the digital divide, help of migrants, etc. So any social enterprise having any of the following social intents can get listed on the social stock exchange: healthcare, education, gender equality, environment, national heritage, rural sport, incubator, livelihood, disaster management, financial inclusion, digital divide to help bridge the digital divide, venture capital, etc. Okay. Now, one more point to remember, that when I say that we've understood this thing, that a social enterprise will get listed, they should have a social intent. Social intent, we said all those categories is very similar to chapter 7 of company law, CSR. So those activities like eradicating hunger, etc. Now social enterprise shall have at least 60% of its activities. Now imagine if you are a social enterprise, at least 60% will be devoted for the target population. Just remember this line, that they will spend at least the money for 60%, 67% for the target population, which is also I feel very less. Okay, that will be given. And these instruments can be listed, will be in the form of zero coupon, zero principal bond instruments. Okay, simple concept is done. We can build 5-mark answer, done. Now remember book closure date and record date. Remember section 91. What is section 91? Book closure and record date. That normally let's say if I'm going to buy shares of Reliance, it's immediately trading, right? So what the government, the company, when they want to give some dividend, that time they will say who to give the dividend to. These shares are continuously being traded, okay, from quickly being traded. So then they said that, listen, it's so much fast trading, we don't know who to give the corporate benefits to. So you will write an line that in order to determine to whom the corporate benefits are given, we have to close the books. When we close the books, no transfers are done. We will say whoever's name are mentioned on the book closure or record date, they will be entitled to the corporate benefits. So book closure dates and record date is done to determine persons to whom corporate benefits like dividend bonus shall be given. So books can be closed 45 days in a year, maximum 45 days in a year, maximum 30 days at one go, and before closing 7 days public announcement is needed. Again, so remember all the numbers. Section 91 talks about book closure, record date. First give the meaning. It is to identify the persons to whom corporate benefits are to be given, so therefore they close the books. On those dates, whoever is mentioned will be getting the corporate benefits. This is given under section 91. It can be closed maximum for 45 days in a year, 30 days at one time, and before closing 7 days public announcement will be made. Okay. Now this very important concept called as bulk deal and block deal. Block deal and bulk deal, very important from exam point of view. They've asked also in the exam. Okay, so what is the meaning of bulk deal and block deal? First, for one, there is a separate window. In this window there is a separate time limit. Within that much time only trading will be done for those. So that is called as block deal. Pay attention, very important. Huh? So a single transaction where 10 crores or more is traded. So in block deal, 10 crores or more is traded. The stock exchange has made a separate window only, trading window they have done for such large transactions. And this can be done only twice in a day. 2 market windows are there, one in the morning 15 minutes before the market opens, okay, and the other one is from 2 p.m. to another 15 minutes, 2 p.m. to 20 minutes, when the block deals can take place. So either in the morning or into this, you will take a 10 crore thing, you will do it from a separate trading window. This is called as a block deal. Okay, it happens through number of transactions. In one transaction of 10 crores or more will be done, and the pricing will be must be between 1% above or below the previous day closing, or so maximum price difference can be 1%. Understand? Today when you go to buy shares, if you've ever traded, you know that shares keep doing on every second, it is changing. So imagine if I'm going to buy 10 crores worth shares, so little bit I buy now, and the price might change little bit. So they say 1% price difference is allowed. 1% price difference is allowed. Again, block deal. So what is block deal? 10 crores or more transaction is done through the separate trading window. There is a separate trading window. Through that I am doing it. There are two windows, two timings where I can do this. 15 minutes are given. Okay, only through one single transaction, and the pricing should be not exceeding 1% of the previous closing day or the volume weighted average price. So 1%. So pricing also they have said it should be two different. 10 crore rupees single window within these two range is called as block deal. Concept clear? Yes or no? Learn it by heart. Block 10 crores, two trading windows, in one go you will do it. 15 minutes time gap is there, and pricing is 1%. Done. So then what is bulk deal? Bulk deal doesn't have a separate trading window, and it is basically just any person randomly buying on the normal stock exchange of 0.5% of the total shares of the listed companies. So if anyone is dealing of more than 0.5% of the total shares of the listed company, it is called as your bulk deal. Sir, what is bulk deal? Of a listed company, imagine 1% also you buy so much of a listed company. So of a listed company, if anyone has done more than 0.5% of the total shares of the listed company they've traded, then it is called as bulk transaction. There is no separate separate trading. It happens during your normal trading hours, that is 9:15 to 3:30. Okay, and it can do it anytime, multiple, trading window, gap, etc. And it can be done in multiple tranches also, and it can take any time during the prevailing market. So what is bulk deal? Remember, if you're trading of 0.5% of total shares of listed company, this is the main thing. One listed company 0.5% I'm knocking off, called as a bulk deal. Report has to be given to the stock exchange. That's it. Okay. Now we understand what is the trading index. Okay. Stock market trading index. Now, understand one thing, that for your NSE and BSE, okay, Nifty is an index and Sensex is also an index. Sir, what do you mean by the term index? Now pay attention. Index for NSE index is called as Nifty, and BSE index is called as Sensex. We have all heard of these terms. Now Nifty captures the top 50 companies by market cap, and Sensex captures the top 30 companies by market cap. Done. Till here it is clear. We knew only this much, but now we will learn how is the calculation done. Nifty must be of some price, Sensex must be of some price. How is the calculation done? So just before we do a little bit of theory, that Sensex, when we say it's a sensitive index, it is an indicator of BSE. It captures the 30 stocks. It was first published in 1986. It tells the performance of the top 30 stocks on BSE. Now we'll see calculations. Free float measure. Okay, free float. Some terms we'll see and then you're done. Free float, base index, etc. Now pay attention to what I'm saying. Now, what is it? Pay attention. Sensex is given here. Now to calculate the Sensex points, how it is done. The base year, okay, they have already given that the base year, when they want to calculate that this was the base year and now it is how much. So base year is 100 points fixed. Market capitalization of the base year is also fixed. That was 11,473 crores. They had fixed it. Base year market cap they took, it was this much. And now for the present we will calculate. What is the present of the market cap of free float? Free float means what? It's freely tradable. It's freely traded. Okay, so what is not freely traded? So it excludes lock-in shares, any shares which have a lien, any shares of the promoter. So all these are not traded, right? So these are excluded. Apart from that, all this is called as free float. So we'll take the total free float market cap now, and that's how you will get the Sensex. A very simple example also I'll give you. So free float means the proportion of shares that are readily traded in the market, does not include shares held by promoters, lock-in period, which are not available in the market. So free float means freely tradable. Now I'll tell you how it is actually done. Very simple calculation, you don't even have to learn anything. I'll tell you. Okay, now pay attention to this. You will understand the formula in one go. Now I'll tell you how the formula is derived. I'm telling you how the formula is derived. Okay, so what did they do? They took the base year. Okay, in the base year they said that we are fixing the base year points to 100. That time they said what is the base year market cap. So the base year market cap was 11,473 crore. This is of today or last time? It is a base year. Okay, so base year was kept as 100 and this was kept as 11,473. That was the market capitalization. Now they will say that if, and what is market cap? It is the number of shares which are freely tradable into the market price. So you get the market cap. Then if today, now today I want to calculate, I'll put my figure here. I'll say currently what is the total number of shares into their market price today. I'll do a cross multiplication. So you will do this into this divided by this. You will get your current year index. So what did we do? It is 100 into current year market cap divided by base year market cap, and this is the base year index. This is the same thing what they've done. They've taken the base year index divided by base year market cap, and here it is the market cap. So you will come to know the current year index. You will come to know. Simple. Nifty is also similar calculation. Now they are given on guidance for investors, not that important. Now, one important point is about market surveillance. Sir, what do you mean by market surveillance? It is market monitoring to ensure that the market trading is done in a market integrity is there. It is regulated by SEBI. So market surveillance. Who does market surveillance? So SEBI plays a vital role in conducting market surveillance. It is the responsibility and given in the objects of SEBI that it is a object of SEBI to object to protect and develop the securities market. Now, this monitoring could be of two kinds of monitoring. One is price monitoring and the other one is volume monitoring. Volume monitoring means what? Monitoring means a surveillance. So they will keep monitoring the price. If there is any abnormal fluctuation in the price, this will be captured by SEBI. If there is a abnormal purchase of huge amount, so they will track your top 10 sellers and buyers data. So they will just keep monitoring to see which is there. If someone is removing a rumor, then we'll see the rumor verification. So these are all monitoring. So you'll write monitoring could be price monitoring, volume monitoring. Done. Okay. Some preventive measures have been given by SEBI. Okay. So again, we can also divide the market surveillance by SEBI as preventive, where automatically if let's say 5% it has exceeded, automatically they have these markets filters if the market filter or threshold is exceeded, automatically trading stops. So if you know that if suddenly it is going 10% and the SEBI has fixed a circuit within this much only it can move, price can move. If it crosses, breaks the circuit, automatically the trading will be stopped. That is like a preventive measure. Post trading is basically rumor verification, top 10 shareholders, etc. So headings we can do. Cancel. Kill switch is basically a person if he is doing excessive trading and abnormal clicking is there, automatically it kill switch means it logs him out. Okay, all this is there. Trade to trade settlement. So Z class securities, they will not allow intraday, that is called as trade to trade. Rumor verification will be done, and after the trade is done, then end of the day alert can come. Any pattern recognition from past patterns they will determine, or any alert from any member will be verified. Okay, then we see one other thing which is called as Fed policy. Very, very simple. This we have to write in our own words after understanding the concept. Now, what is the concept? Understand that as RBI is there, RBI is the regulator in India. Similarly, the regulator for your monetary market is in US is called as Fed. Now we know that as RBI issues their fiscal policy, Fed issues their Fed policy. They issue their Fed policy. Sir, what is Fed policy? Fed policy is basically change as a RBI does to control inflation. What else does the RBI do? Same thing they will also do. They do for monetary policy is there. Payment settlements is handled. Same thing is handled by RBI. So whatever functions of RBI, just write the functions of Fed. Okay, payment settlement, ensuring that there is a financial system, controller of the financial system, promotes consumer verification, consumer protection, etc. Okay, then credit policy, just like RBI issues credit policy for growth, etc. Market stability, balance of payment. RBI, this one can also do. Now there are some rates given. Okay, now remember, two are long term. So bank rate. Now remember, when RBI or commercial banks, okay, so when bank rate, what it is, okay, so when now pay attention, I'm telling you bank rate, repo rate, reverse repo rate, all three I will tell you in very simple terms. Okay, so bank rate is the rate at which RBI gives loans to commercial bank. Again, what is bank rate? Bank rate is where RBI gives long-term loans. Now remember the word long-term loans to commercial banks. Now when you give long-term loans, bank gives you a long-term loan, don't they take security? Here also RBI will tell the bank that you are taking a long-term loan from me. RBI is giving a long-term loan to the bank, so they will say keep some security. So the bank, if it has a purchase some assets, they will keep it. So any government security, any other security with the commercial bank already has, they will keep as security. Okay. Now remember, if the bank rate is increased, what will have the effect? So obviously what will happen is commercial banks will not be able to take loans from RBI because the loan is now become expensive to them. So it will become expensive to the people. So people will have not take that much loans, and that is why it will control or limit the money supply. It brings the money supply down. Now repo rate. Repo rate is same thing. RBI provides short-term loans to commercial bank. Short-term loan is repo rate. See, the same thing is, and here they don't take much security since it's short-term only. So a repo rate is where commercial banks borrow from RBI. Okay. And it is at a for temporary loans are there, so therefore security is not given that much. Now see cash reserve ratio. So this much amount of cash is to be maintained by commercial banks. If they increase it, then more cash will have to be parked, so less money in the public. See, now why is this? Because RBI controls the monetary policy or money supply in India. Similarly is statutory liquidity ratio. It contains the cash and cash equivalents. Okay, so how much commercial banks have to maintain cash and other cash equivalents. Reverse repo is exactly opposite, where reverse, now opposite only happens. RBI is borrowing from commercial banks. Why will they do this? To suck out the funds from the market. So RBI, if they increase the reverse repo rate, they will borrow them. So banks will want to give loan to RBI. So they will make FD, they will give the money. So remember, repo rate and bank rate is same, except that is one is long term, one is short term, which is normal thing that happens. A commercial bank is taking loan. In reverse, other way it happens. Commercial bank is giving a loan to RBI. That's it. Just remember that line. Okay. Inflation index. Now, what is inflation index? Inflation is the increase of price over a period of time. Index maintains a collection of data, okay, based on certain thresholds or baseline or base index. The inflation is a economic tool to measure the rate of inflation in any country. Now, what is most important here is to know two kinds of inflation index. One is wholesale and the other one is consumer. Consumer is your retail level. Pay attention. Wholesale price index. So it tracks the inflation that happens at the wholesale level. It covers only goods. It is done by the Office of Economic Advisory, Ministry of Commerce. Now wholesale, so it happens at the first stage, manufacturing stage. It covers manufacturers and wholesalers only, and types of commodity covers is all industrial goods, your intermediate goods, minerals, etc. And the base year that is taken is 2011 and 12. Again, wholesale price inflation. So I want to see the inflation that has happened in the wholesale segment. So wholesale is between manufacturers and wholesalers only. I want to know and only goods have taken in this stage. It is at the first stage only. Manufacturers and all these commodities will also be manufacturing goods, intermediary goods, and the base year for wholesale is taken as 2011. When I say consumer price index, means at what price consumer are getting. So who sells to consumers? Retailers, na? So retail pricing, we will see how much it has increased. This calculation publishing office is done by the National Statistical Office, and here we take goods and service. This is happens at the final stage. Obviously consumer is at the last stage. Prices paid by the consumer will be seen, and services, everything, education, consumer, transportation, food, beverages, everything, and the year they have taken is 2012. Base year will be revised from time to time. Okay, that is it. So you can remember that who is the releasing body. One is goods, both, and the other one is goods and services. Items in wholesale, 697 items are covered. In consumer price index, these many items are taken. With this, we have completed the entire chapter. Thank you. Clear till here? Yes or no? Everyone, have you all completed? Everyone, have you all completed with me? Because now we have to complete it by 5:30 everything. Okay, so now I'll go faster on the other chapters. Now, which is the other chapter? Everyone, SCRA Act. We're going to cover SCRA Act and only the important, not that important. So only what is necessary from exam point of view I will cover. Ready? Yes or no? These three are super simple. All this maybe in 10 minutes I'll wrap up. Okay, in 10-15 minutes I'll cover each one. 10 minutes each. 10 minutes each we'll cover. SCRA, SEBI and this. Clear? So all these three we should cover and complete it. Chalo. We'll take a 2-minute break and then I'll come back and complete it. Okay, all the three I'll cover in one go. Till then you can revise something. I'll just take a 2-minute breather and come back. Okay, till then if you don't like the video, please like the video. That's it. Hi guys, am I audible and visible to you all? Please put in the chat box so we can quickly start and complete this chapter. Am I audible and visible? Just let me know in the chat box. Okay, quickly, I'm just waiting for your message. Faster you respond, the faster it is easier for me to start. Is it sufficient to score 70 plus? Obviously we are covering every single thing from that chapter, okay, all the important things, so obviously it's enough. Okay, great, let's start. Hi, so we start with your Securities Contract Regulation Act in 1956. Now, if I have to understand what is this this act about, so this act is basically regulating all the contracts that are entered in securities market. Now, first thing is right from the stock exchange, NSE, BSE, you have your commodity stock exchange, etc. How do they get their license? The entire thing, the stock exchange, in order to be set up, they have to take a license from central government. Central government regulates these particular contracts, oversees the contracts. If they find that any stock exchange has violated, so first of all, license is given by stock exchange by the central government. If you've not done anything right, then obviously the appeal can go to SAT, and from that it can go to Supreme Court. So contracts are regulated, and stock exchange are given permission provided they comply with the 1956 Act. Now, what could a stock exchange be given rules? So first thing is a stock exchange has to give a proper platform. They have to give a proper platform for us to trade. One. Second, the stock exchange has to follow a lot of rules with respect to auditing, with respect to having a certain number of softwares, people, etc. The next thing, if you go to see, a stock exchange has to ensure that they have a proper settlement or clearing corporation. They should have a clearing corporation that ensures that settlements of trades are done properly. So all this the stock exchange has to do. If they don't do, they can be given a direction, and direction like a warning. If they don't follow that, then the stock exchange can be dissolved. Okay, and the appeal mechanism is simple: SEBI, SAT, Supreme Court. Now, one more point they say, even which we know, is your minimum public shareholding. Every stock exchange has to ensure that a company has to have minimum 25% of shares should be held by public. Now, if it is going to be a listed company, obviously public should be there. At least minimum 25% should be there. If it is not there, it is breach. Let's say 75 or 76% is bought by the promoter group. In that case, it will be told that listen, 1 year time you get to bring your level back to public shareholding level back to 25%. Let's look as and when we do the chapter, what will we see? Okay. Now, when we are looking at the chapter, we are understanding few things. One is the SCRA Act. Now, the SCRA Act 1956 is made to prevent undesirable transactions and contracts and in India, and to regulate the working of stock exchange. So very, very important is, what does the SCRA do? They regulate the working of stock exchange in India. Now, we had done one part, okay, that remember that initially when you go to see the evolution of the stock markets, it had come in the form of a banyan tree. The entire initial part, the stock exchange flourished from the banyan tree, and this was the person in Dalal Street, Prem Chand Roy Chand was the one who founded the stock exchange, Bombay Stock Exchange, okay, on the Dalal Street, which is in Mumbai. Now, This is the evolution. Now there were multiple regional stock exchanges, just like there was in Bombay, there was in Calcutta, Madras, Bengal. These were all the stock exchanges that were there. The objective of any stock exchange is, now what is the rules, what is the responsibility of a stock exchange? Is to ensure that we have a nationwide trading facility. We have proper payment, settlement, delivery, clearing corporation should be there, that proper settlement should be done. International standards are followed for security market. So this is important. This entire act regulates the working of a stock exchange. So you should know that what is a role of a stock exchange or the duties of a stock exchange. Let's see. We have two national level stock exchanges in India. One is BSE, which was established in 1875, and NSE, which was established in 1992. Okay. The benchmark for Sensex is your BSE Sensex, and the Nifty for your NSE, it is Nifty. This is Nifty, and for Sensex it is for BSE it is Sensex, and here it checks the top 30 stocks, it tracks the top 50 stocks. Okay. Now, so again, what is the objective of the SCRA Act? The objective of the SCRA Act is to prevent undesirable transactions in the security markets, 1, and to regulate the working of the securities market, 2. 1 and 2. Simple. This chapter is pretty predictable and very clear what can be asked. So even if a lot of thing is given, I can tell you exactly that these questions come. Okay. So now first, remember one small little point, that initially the stock exchange was broker owned. It was broker owned. Okay, and it was mutually owned by brokers. As we saw that Premchand Roy Chand, he was a broker, he set up the BSE. Then slowly the stock exchange, which was BSE or NSE, said that instead of broker owned, we will make it into a corporate structure, corporate owned, publicly owned stock exchange. Okay, so this concept, from mutually taking away the rights from them, we made a demutualization of stock exchange. Demutualization from broker owned to public owned. Okay, it's called as demutualized. Now it's not mutually owned by the brokers anymore, and now it is called NSE Limited and BSE Limited. Okay, BSE Limited. Why? Because it is no longer broker owned. Now let's get into the chapter and complete it. Okay, so your main part of the acts are divided, that the central government is establishing, one, how to establish the stock exchange. If anyone wants to establish a stock exchange, how can they do that? What are the penalties that is there, that is covered, and what are the responsibilities of a stock exchange. So central government. So we start section wise. This was just the background of what we were doing. Now we will start section wise. Now in the exam, once they had asked, what is the procedure of establishing a stock exchange? Process of setting up a stock exchange. If I ask you, what is the process? What is the process of establishing a stock exchange? So very simple, you write section 3, 4, 5. Application, every stock exchange which is desirable or being recognized will have to make an application to the central government. Simple. Central government has given the powers further to SEBI. Okay. So if today I want to make a any kind of stock exchange, I will have to write to central government, which they have given the powers to SEBI. And from this only you will come to know that if there is any dispute from SEBI, you will go to SAT and then Supreme Court. Section 3, subsection 2 says every application shall contain particulars and accompanied by the bylaws of the stock exchange. So you will also take the bylaws of the stock exchange. You will make an application to the central government. Simple. Now once you apply, in the next section the recognition is granted. So section 4 of the act says that you get recognition as a stock exchange. So if the central government is satisfied after making the inquiry, it will grant recognition to the stock exchange. 3 I apply, 4 I get the recognition. 4A has now said, as I told you, that now it is no longer broker owned, it will be demutualized. No longer broker owned, it will be publicly owned, and it will be into a corporate structure. So all stock exchanges in India have to be corporatized and demutualized. This is the next 4A we will write. Okay. What is the procedure for corporatization and demutualization? It will be set up as a company and they will have majority public shareholders and public directors. All stock exchanges referred under this, okay, shall submit a corporatization and demutualization or this. On receipt of the scheme, the SEBI will approve the scheme. So application is made and then it will be approved. Next, till now everything was cool and nice. What did you do? The first part of the act says that someone who is desirous of setting up a stock exchange is approached, they get the recognition concept over. Okay, you make it all this. So you take an application, you give an application, you get approved, and it will be demutualized and corporatized. Done. Now imagine I'm functioning as a stock exchange. Central government will have a supervision. They can call for the records. So power of the central government to call for the records and ask for inquiries. Section number 6. Every stock exchange shall furnish periodical returns to SEBI. I told you all the powers of central government are given to SEBI. So every stock exchange will give their periodical returns to stock exchange. Every recognized stock exchange shall preserve the books for a period not exceeding 5 years. So very, very important. Preservation of books of accounts and other documents will be for 5 years. So 5 years you have to preserve books of accounts. So very simple. We're going in order. Section number 6 is your responsibility. Okay. You have to give periodical returns regarding its affairs to SEBI. Annual reports also has to be given. Next, power of recognized stock exchange to make their own rules. So a stock exchange has a further power to make bylaws, of how the rules, regulations will go, restrictions, voting rights, any other thing. Simple. Now let's go into one thing which is called as clearing corporation, which is your section number, section 8. Okay, let's see. We are going to understand the concept of clearing corporation. What concept we are understanding? Concept of clearing corporation. In a stock exchange, imagine if a seller is there. So the seller sells his securities. Okay. Let's imagine in a stock exchange, I have opened my trading account and I have sold my securities. Now it is responsibility of the stock exchange, and in stock exchange they have kept a clearing house. This also they've asked in the exam. Okay. The clearing house will ensure the settlement of trades are done. So what he will ensure? Settlements of trade and periodical payment is made. So they will collect the payment and then they will give it in the seller's account. Simple. Okay. Now we see clearing corporation. Very, very simple. A clearing corporation is an organization made by the stock exchange. So clearing corporation is an organization set up by the stock exchange. What is the role of a clearing corporation? Market is important. Role of a clearing corporation. So a clearing corporation is responsible for settlement of all trades, ensuring that there will be, like, I don't have to worry that if I sell I will get the money or no. It will bring and sustain confidence with respect to clearing and settlement of trades. They will promote the maintain proper settlement cycles, or T+2, which is shrink to T+1, which is now become T+0. Means today only if I sell, today only the money and everything will be hit in my account. They ensure that there is no counterparty risk and ensure that there is a risk management is done. So a clearing corporation is a organization set up by the stock exchange having the following functions. What they will do, just imagine it's like a officer who will ensure that all the money is done. So they will ensure confidence, they will settle the trades, all the settlement cycles will be followed, T+1, T+2 will be followed. Counterparty risk is guaranteed. Imagine if the other side is not paying, so I don't have to worry on either the other side will pay or no. It is guaranteed by the clearing corporation that they will recover and give, and they will have proper risk management procedure. Simple. So section 8A says that the stock exchange will ensure that the clearing corporation does periodical settlement of contracts, delivery of securities and payment of money, and any other matter which is connected herewith. Very, very simple. If you can understand the concept, you can write also. Periodical settlement of contract, delivery and payment of securities, and any other matter which is incidental, consequential and supplemental to the aforesaid thing mentioned. Simple. Now, again, one very simple point, we have seen that a power of the stock exchange also has a right to make its own bylaws with opening of the market, closing of the market, clearing house rules, etc. Okay. Now, one simple thing they have said that if, now this is section number 12. Now, till now everything we were telling that you made an application till subsection 5. Now subsection 6 we granted you the application, and now we are telling you to give returns, records, maintain for 5 years the books of accounts, etc. Now what is happening is, we told what is a clearing corporation, etc. Now the problem starts. Now we're going to start with problems. Sir, what do you mean by problems? Section 12 onwards, it is coming that action is being taken on the stock exchange. So there was once a stock exchange in which there were so many scams that central government ordered it to be shut down. Okay. So central government is empowered to suspend the business of a stock exchange on emergency basis. Okay. By issuing in the official gazette for a period not exceeding 7 days. So what is happening? We are issuing a suspension order. Suspension of stock exchange is done for a period not exceeding 7 days. Now before suspending, it is obviously an opportunity being heard will be granted. Now, one simple point they said that additional trading floor can be given, is a facility to buy and sell. Okay, trade that also can be provided in the stock exchange. We are seeing delisting. So always remember, now we are going into things about problems, issues that will arise and what will happen. So a recognized stock exchange may delist itself voluntarily on the grounds mentioned. They can do it, but they cannot be delisted without being given an opportunity of being heard compulsorily. A listed company or any company, any investor aggrieved can file an appeal before SAT against the decision of the recognized stock exchange within 15 days. So very simple. Delisting, a stock exchange may delist the securities on grounds they will mention, provided that the securities of a company shall not be delisted without giving the opportunity being heard. So this is about stock exchange delisting securities of a company. If company is aggrieved, unhappy with the decision, they can go in appeal to SAT, to Securities Exchange, to Securities Appellate Tribunal. Simple, right? So we had done compulsorily in delisting of security. You've done compulsory delisting. Here, if you are being compulsory delisted, you can go in appeal to SAT is what they have given you. Okay. Always the provision will be simple. If anything wrong is going on, I'll go in appeal to SAT. Now again they're telling you, right, section 22, right of appeal against refusal of the stock exchange to list the securities of public company. Now this also they have asked in the exam, that there was a company company wanted to get listed on the stock exchange, every time we write in principle approval of stock exchange to get listed. If, now they are saying, if stock exchange refuses to list securities of a company, they say no, we will not list, then what will happen? So that we are going to read. Okay, so go in appeal to SAT. Always remember the appeal is SAT. Where a recognized stock exchange refuses to list the securities of any public company, okay, the company may appeal to the central government against the refusal or failure. So they will appeal to central government against the refusal, omission, etc. within 15 days from the date of such refusal, or where the stock exchange has omitted to or failed to dispose of your section 73, that is your deposits chapter. The application for permission of the shares or debentures shall be dealt with on the stock exchange within 15 days from the expiry. Again, just remember that within 15 days. So if stock exchanges, just write this down, if stock exchange refuses to list the securities of a company, then here they are saying appeal to central government, okay, within 15 days of refusal. Simple. This is the provision under section 22. Now regulation section number 22A, right to appeal to SAT against the refusal of securities of public company. I told you it's SAT or central government. Where a recognized stock exchanges refuse to list the securities of a public company, the company may appeal to SAT against the order within a period of 15 days. So remember this, it's actually all the powers as we had done, central government powers have been given to SEBI and appeal provisions have been given to SAT. So this is what you will write. Here you can write in 22A they've given the powers to SAT as we has discussed. Same points, same everything. What is the appeal time frame? Mark it as super important. Okay, that if any person, if any entity is unhappy with the decision of SEBI, they will go in appeal to SAT within 45 days from the order of SEBI. If you are unhappy with the decision of SAT, you will go to Supreme Court within 60 days from the order of SAT. Okay, so from here 45 and 60 days, 45 and 60 days, simple. Now again, very important, another thing is recovery of money, section 23J. So we saw a full sequence that first application is given, then grant is given, then direction is given, then we start about the issues, refusal is given, then what you will do. Now they are saying that if order is passed against you, or if an order has been passed that you have done a unlawful gain of 20 crores. So the disgorged amount, disgorgement means what? Whenever they use the word disgorgement, means the wrongful gains. Disgorgement means the gains, the wrongful gains that you have got, that has to be returned. Now obviously if the person is saying I won't give or I don't have, then how will we do? So if SEBI, so this is also important, this also they've asked in the exam. If a person fails to pay the penalty imposed under the Act, so if a person fails to pay the penalty under the Act, okay, then SEBI will tell him to refund all the money that he has got, and the disgorged amount also has to be refunded. Pay attention, disgorgement order, disgorgement means all the wrongful gains you have to return. A recovery certificate will be issued and given to the recovery officer. For example, government, SEBI will pass an order that go and recover so much money from him, he has and he has to refund the money. Now the officer can recover the money in any of the following ways. Just think, how will say if a person, how do they start off? If a person fails to pay the penalty amount, then we will appoint a recovery officer, tell him to get the disgorged amount, issue him a recovery certificate. then that officer will go and recover in the following ways. How he will recover? He can attach the property, attachment of property, he can sell. So this thing, if income tax, how do they recover this? Attach your property, sell it. They attach your bank accounts. Movable property will be taken, immovable property will be taken. So this is about movable property, this is about immovable property, this is about bank account. If still not everything we didn't get, then we'll arrest the person, and we can also appoint a receiver to sell the liquidator to get the money. So these are 5 modes of recovery that we can do from the person. Simple little easy points. Okay. Now, okay. Then they've given you a few penalties. They've given you a few penalties which is there. Now penalties, obviously you cannot learn all of them, but at least one you can learn and quote it. Okay, I'll give you one important penalty which is quotable or mention. If you can't remember all, obviously it's not possible. At least this you can learn and write it down. Where it is 25 crores or 10 years or both. Okay, 25 crores or 10 years or both. So at least you can mention section 23 and 24. So in the penalty provisions you will write section 23 and 24. So you can write section 23, don't write the sub clause, just write section 23 and 24. Any penalty provision comes, just write it as per section 23 and 24. The company or the person can be held liable for 10 years or a fine of 25 crores or both. Okay. So this line you can mention that as per section 23 and 24, the company can be held liable, or the person, the violator, can be held liable for 10 years imprisonment, 25 crores or both. Okay, if you remember exact ones, you can write it. If not, a general one is fine. Then we are done with the SCRA Act. I have covered all the provisions and sections from the Act. Now we will be doing the SCRA rules. Act was of 1956. The rules is of 1957. Sir, do I need to know all the rules? No, I'll tell you which one you need to know. Whichever the minimum public shareholding. You need to know rules of Rule 19. Okay. Most important rule. Okay, Rule 19. One is about that a stock exchange has to have all the copies of the following documents. Okay, the seal, prospectus, balance sheet. This is general. The most important is minimum public shareholding. Minimum public shareholding, Rule 19A. Okay, so from SCRR 1957, you don't need to know everything. At least the Rule 19A you can know, which is talking about minimum public shareholding, which is super simple, 25%. So company, every listed public sector company, okay, shall maintain minimum public shareholding of 25%. Okay, if at any time the level falls below 25% within 1 year, they are giving different days, but just write a generic one. Within 1 year, they can have to get the level back up. Increase the shareholding to 1 year. Okay, so for different time zone they have given differently, but you can mention this, that maximum within a period of 12 months you have to do it. So one was commencement of the act. This is general. If today to any company's public shareholding goes below 25%, then within 12 months they have to rectify the default. So let's say promoter shareholding became 76. So they will sell off their shares. So now they've also said that, let's say for example, if the promoter and public shareholding, okay. So if the public is holding minimum 25% of the total shares, promoter can hold how much? Maximum 75%. Simple. Now let's say if by mistake or someone is holding 78%, 76%, okay, 76%. So it is a violation of the law. because minimum public shareholding is 25 and you are holding only 24. So you get 1 year time to bring the level back to 25%. Now how you will do it? How will the promoters now bring the level up? So obviously they can do a offer for sale. What they can do? They can offer for sale. The promoters will sell off their own shares, or they will do issue of securities. These are the two simple things. In issue of securities, you can issue shares, you can issue XYZ, anything to reduce their securities. You can issue bonus shares, right issue to QIB. You can even issue to qualified institutional buyers. Okay, to maintain the public shareholding. This is very, very important. You have to remember. Okay, so this was modes of increasing the level back to 25%. Now delisting of security, we have a separate chapter only. Okay, so you can remember that. Rule number 21 says a recognized stock exchange may delist any securities on any of the following grounds. So if a company has done any of this, they can be delisted. So nobody would want to be delisted, but they will be delisted under the following categories. One is they have incurred loss for preceding 3 consecutive years and it's a negative net worth. So past 3 years there is a loss, negative net worth, it can be delisted. Or if the securities, trading of the securities has been suspended for a period of more than 6 months. Or last is they have remained infrequently traded for past 3 years. Or any of these promoters, okay, have been convicted for SEBI laws, or address of the promoters is false or not known, or they have absconded, or the minimum public shareholding has fallen below for a period of 1 year. So how many points they have given you? How many points they have given for delisting? Remember, the delisting has been given in Rule 21 of SCRA rules 1957. A recognized stock exchange can delist any securities on the following grounds: incurred losses for 3 consecutive years and having a negative net worth. Next, the trading is suspended for more than 6 months. Next is it is traded but infrequently traded for 3 years. So still it is a ground for this. Promoters are either convicted or they have given a false address. Address is false. Minimum public shareholding falls below the level that 25% has been fallen below. In all these cases, after giving an opportunity being heard, it will be delisted. Role of company secretary. Okay, the company secretary can represent the companies, act as a legal representation before the SAT, etc. if the company is there. Okay, that is it. And with this, we have completed the entire chapter, including all the past exam questions. Thank you. So this is important, and I've covered what comes in the exam also. Okay, apart from this, you could say that it's not that important. All the important things I've covered. Thank you. Clear till here, everyone? Yes or no? Is it clear? Yes or no in the chat box? Our target is to complete this entire all these things by 5:30. Yes or no, so we can quickly start and complete the next chapter also. I want in the chat box yes or no. Yes, great. So we start with the next chapter and complete it. Okay, so we'll take a 2-minute break and start. Till that you want, you can revise something. 2 minutes, I'll come back. Super clear, great, thank you. And just remember, in case if you are leaving any chapter also for the exam, please go through the past exam questions. It is all available on my website. Okay, so just you go to my website. On my website, in the free study material section, you go to this executive. you will get almost 3,400 students have downloaded the scanners. Okay, so I'm also referring the scanner just to know what all is the past exam questions. Okay, so if you're leaving any chapter, you can at least know that these are important and these are not. Okay, so we will start and complete this chapter. I'll just go through the exam question. Give me 5 minutes, we'll be back. Okay, so we'll be starting with the stock exchange, SEBI. Okay, now, hi. So we begin with the chapter called as Security Exchange Board of India. In this chapter, it's very simple what exam questions also come, and it's pretty limited and easy. The first part they talk about SEBI, why was it made, the objectives. Second, they talk about the appeal provisions, and another part they talk about is SEBI directions to companies, etc. when they have to comply. That is it. Okay. So these are the few parts which we can quickly complete it. So SEBI was before the Security Exchange Board of India, we had the the SEBI Act, we had the Capital Issues Act 1947, and we had instead of SEBI, we had the controller. And now we have the SEBI Act 1992, and the SEBI is the regulator of securities market. Its headquarters is in Mumbai. SEBI has its head office in Mumbai, and they also have presence in Ahmedabad, Jaipur, Kolkata, Bhubaneswar, New Delhi, Chennai and Bangalore. Okay, now we'll be seeing section number 11, the most important. Okay, the powers and functions of SEBI. So section 11 contains the powers of SEBI. The principal functions of SEBI is to protect the interest of investors, regulate and develop the securities market. The other functions so protect, develop and regulate the securities market. The other functions are with respect to business, exchange, registering and regulating all the intermediaries, registering the all the thing that we've done. Intermediaries, everything will come. Promote education, insider trading, to prevent insider trading, takeover, all the chapters that we do, that's the job of SEBI to overlook all these aspects. Okay, now when we start, they say section to regulate and prohibit the issue of prospectus, offer document and soliciting money for issue. Let's see section number 11A. SEBI may prohibit the protection of investors, power to issue directions. Now what they have said, first one, section number 11A, that SEBI shall prohibit the protection of to protect the interest of investors. They will prohibit issuing any offer document to public to protect them. They can issue directions. Now section number 11 is about directions. They will issue directions to the people in the interest of investors to prevent any unfair trade practice. First if you go to see, there is a sequence. Okay, section 11A talks about directions. They give you a direction to any person in the interest of investors and orderly development of security markets. Direction can be given. Okay, then if they feel right, okay, and they have reasons to believe that someone has done something wrong, detrimental to the interest of investors, then they can conduct an in-depth investigation as well. And now, so this is about SEBI section 11, 11A, 11B that we have seen. Now we come to the another important body. If any chapter comes from here, it is about SAT. Okay, so Securities Appellate Tribunal. So we'll just learn the headings first properly so we can quote it. SAT. So chapter 6B of the SEBI Act talks about establishment of SAT against the SEBI order. So if anyone is aggrieved by the SEBI order, they'll go and appeal to SAT. Section 15K, okay, talks that the central government is empowered to establish more than one tribunal, more than one SAT can be made, and central government is set up the tribunal at Mumbai. Powers of SAT. Now what is the powers of SAT? So they have all the powers of a civil court, okay, with respect to summoning a person, requiring summoning a person, a document, receiving affidavits, reviewing its own decision, issuing any examination of witness, okay, setting aside any order or giving ex parte order. So these are all the powers of SAT. You have to write it. They have the same powers as that of a civil court. Okay. Then we see the Supreme Court. If you are unhappy with the decision of SAT, okay, which 15K is SAT and 15Z is Supreme Court. A person aggrieved by the decision of SAT will go and appeal to Supreme Court. So take a screenshot of this and you will mention it and write it. From SEBI to SAT to Supreme Court, 45 days and 60 days. Okay, and that is it for this chapter. So that is it from this chapter. Only SEBI section 11 and the appeal provision is important. Thank you. Now we start with the next chapter, which is called as Depositories Act. Okay, so in the past exam question also they've asked only that much. Now we're going to start with Depositories Act. Okay, now we'll be starting and completing your Depositories Act. Okay, so we have to target to complete all of this by 5:30. Then you're sorted. You have good enough time to complete part B. Okay, now we're going to see Depositories Act. Let's see, 2 minutes we'll start. Let's see what all contents are there. Okay. So just looking at the past exam questions and then we will start. So till then give me 2 minutes. Looking at the past exam questions. So this past exam questions you'll get it from my website. Free resources, you can go and download. So any chapter you're planning to skip or you want to start, just look at the exam questions at least. Very simple question. Okay, so good, just write GTG in the chat box. I'll start and complete this chapter also. GTG in the chat box quickly. Am I audible, visible, yes or no, so I can quickly start and complete this chapter. Yes or no? GTG in the chat box so I can start and complete. Okay, so whatever I'm covering, I'm looking at the past exam questions also. Just be a little fast, responsive, so I can also move ahead quickly. Okay, so good to go. Let's start. Hi, so we start with a topic called as depository. Now, a depository is actually a organization. Now you can learn the meaning it is a organization that holds securities in electronic form. Okay, so in India there are two bodies, that is NSDL and CDSL, that holds securities in electronic form. Now if today as you as an investor wants to hold shares in electronic form, you cannot directly go to depository. You have to go through a medium called as a stockbroker, or correctly called as depository participant. Nowadays brokers are depository participants as well, but the correct terminology is depository participant. Okay, so who is a depository participant? Depository participant is a interlinked interface, or it is called as an intermediary, okay, which helps the investor converts his securities to electronic form. Okay, so there are two depositories in India, NSDL, CDSL. Okay, now see the process, how it works. Let's say if an investor is here, investor applies, if they want to hold securities in electronic form, they will apply to depository participant. Who is a depository participant? A depository participant is a intermediary. Okay, and actually the application, so if you want to have a dematerialized, you will have to apply a dematerialization request form. So this is a dematerialization request form. You will give it to DP will give it to the depository. Okay, NSDL, CDSL. Once approved, the depository will tell the particular company that listen, this person has come, he has applied for electronic shares of your company. The company will give a go ahead, then the depository will inform depository participant, and the depository participant will inform the investor. Now almost by regulation number 40, regulation 40 of SEBI LODR, all listed companies have to mandatorily have issue shares through demat. So issues will be done through demat mode only, online mode only. One, even in Companies Act, rule number 9A and 9B states that all public companies also have to have their shares in issues in demat form. Even all private companies except your small company, they also have to do. Only small companies are exempted who can issue in not demat form. Okay, now imagine if my shares have been allotted in demat form, but I say I don't want in demat, I feel very risky, I'm not used to online. So you can give an application for rematerialization request form. So a RRF can also be given, rematerialization, where I say I want my physical share certificates I want. Can you do that? Answer is absolutely yes. Companies will issue only at the time of issue only in demat. But if investor wants, they can apply for physical share certificates also. So the application will be given to DP. DP will inform the company. DP will inform the depository, and depository will inform the company. So remember this graph, and accordingly you will be able to draft your steps also. Okay, so we are done that depository is there, they hold securities in electronic form. Simple. What is the benefits of a depository system? You have everything in electronic form. Okay, all the risk associated with physical share certificates are over. Okay, then we can see your immediate transfer and registration of securities, because rather than physically, this happens on immediate basis. Faster disbursal of corporate benefits. So obviously dividend is also given online way only, so it's faster. Okay, reduction of huge paperwork and paper volume. Okay, elimination of securities, problem related to securities held by minor, because you make his account and then the guardian can hold. Okay, It's less expensive and less time consuming. Remember that all the shares which are held in demat form, electronic form, will be fungible in nature. Sir, what do you mean by the term fungible? Which brings me to the next concept of what is fungibility. They have asked in the exam in the past also, what is fungibility? Let's see. Remember the section 9. Section 9 states that all securities in depository form will be in fungible form. So all online shares are fungible. Sir, what do you mean by fungible? That means they will not have any distinctive number. So they will not have any distinctive number like how you have in physical share certificates, and all are interchangeable. Whereas in physical share certificate, not all are same. There are distinctive numbers, right? So this is not same as that. Value must be same, but this is still different. But that doesn't happen in fungibility in your physical in your online shares. Fungibility refers in finance to any goods, okay, capable of being substituted with each other in the identical form. They become interchangeable, easily interchangeable. As we are aware, in physical share certificates there are distinctive numbers. When a physical shares are dematerialized, they lose their identity number, which is called as fungibility. So section number 9, that no electronic shares, no dematerialization shares will have distinctive number. Simple. Now dematerialization we did. You have a DRF form. I told you the process. Now in the exam they had asked once, how can you apply for rematerialization? It's the same procedure. Investor always applies to DP. DP applies to depository. Depository talks to the company or the issuer. Done. And maybe in the issuer they might have their own in-house, or they might have a registrar and share transfer agent, a separate entity to look after their share transfers. So accordingly those communications will be made. Now remember a depository and custodian. Difference between a depository and custodian. A custodian has custody of anything. Could be gold, could be anything. Whereas a depository has custody of online shares. Depository is in share market, or a custodian is generic name. Now depository and bank. A bank has bank account, whereas this has a demat account. Bank has money, this has shares. Bank ensure that funds are kept in safe hands. Here they ensure that the securities are kept in safe hands. So very simple, we can move ahead. Okay, demat account opening process also I told you. Investor always applies to DP, and then DP applies to the depository. Then there is a concept of immobilization. Now understand what is the meaning of the term immobilization. Immobilization means what? Depositories today, now pay attention to this concept, because this is also they ask in the exam. What do you mean by the term immobilization? So today depositories like your NSDL, CDSL, they also give you a facility that if anyone has some physical share certificate, we will save it, we will preserve it in our locker vault. In our vault we will save it. If any company has made issues, okay, has made a bonus issue, any future issue they have made, right issue has been made, we will hold it in book entry form only. Okay, that is called as immobilization. Why would I want physical share certificates to be kept? Now physical share certificates are more difficult to transfer, so it is more safe. Online, if I don't feel it is safe, any time it can be debited. Physical is not that easy to be transferred. That is why I convert it into physical and I save it with the depository. This process is called as immobilization. So immobilization is where physical share certificates are kept in the bank in the lockers, in the vaults of depository for safe custody, is called as immobilization. Now obviously electronic form entries will not be made. All entries will be made in book entry form because it is physical, not electronic. The actual owner has a right to withdraw these physical share certificates also. If any fresh issue is made, it can be given as a jumbo share certificate representing the entire issue. For example, if company is giving me 20 shares, I will tell the company I don't want online, issue a jumbo share certificate telling share certificate number this to this are contained. Shares from this number to this number is there. So that's called as immobilization. So it is a facility given by depository to hold physical share certificate as custody or safe custody. Simple. Now, in the Depository Act, now all that we've done is covered in the Depository Act is of which year 1996. Now from here, only few important things are there, rest all is covered in the same concepts. So we will do only that. Now this point we've already done in the earlier part, which is 9A, 9B, that dematerialization regulation number 40. All issuers have to issue in demat form. All in rule 9 and 9A and 9B, all physical or public companies and private companies have to issue in demat form only. Only small companies are allowed to issue in physical form now. Fungibility also we've done, section number 9. Okay, now very simple. Now it's a very simple sequence also. Who is the regulator of stock market? SEBI. So SEBI has the power under section 18 to call for inquiry. When they find some mistakes, they can issue directions, and if it is there, and they can take pass orders as they deem fit also. Simple, not very important. Penalties have been given. They can make their bylaws. Now, what and only thing is important is 3 types of audit is there. Audit of depository participants. Okay, so we are now noting audits. Now what we are doing is only 3 important things and we are done. Audit of 3 things. Okay, let's see. First one is your audit. Okay, let's see, company secretaries are allowed to do audit of depository participants. So your regulation number 76. Okay, every issuer shall submit a audit report on quarterly basis, okay, audited by the CA, CS, CMA regarding the reconciliation of the issued capital which are held by the depository and any changes in the stock markets, etc., where the securities company is listed. Now the audit report will be given within 21 days. The audit report required to be is required to give the updated status of the register of members, confirming that all the issuer has subscribed, has converted everything to demat form within 21 days of the receipt of the request by the issuer, and the dematerialization is not affected without any delay. Now first thing is audit under your depository participants regulations 2018. Very small thing but very easy also. So it is a audit done for the purpose of reconciliation of share capital. So you'll write audit for is in your regulation number 76 for reconciliation of share capital, so held with depository. Okay, so who does this audit? This audit is done by either a CA, CS, CMA. Okay, that they will come and they will see that, listen, if these many securities were issued in the depository, it is there with issuer has issued, whether it has come in the depository's details or no. So that reconciliation, calculation, or we could say matching will be done, that the issuer has issued so much, does the depository also have that much? That is one thing done. Next, another type of audit is an internal audit of the depository participants. Depository participant. Now this is again an internal audit done on quarterly basis by company secretaries. So they have NSDL and CDSL have allowed company secretary. Okay, that now this is NSDL, this is CDSL. They both have given the power to CACS CMA to do an internal audit on them. Every DP shall ensure that the internal audit is done at a time not within 6 months by a CACS CMA, and a copy has been sent to the depository. Similarly, this one is also said, and we will check whether all the laws have been followed, rematerialization has been done, demat has been done properly, account has been opened properly, transmission has been done, investor grievances has been managed properly or no. Okay, closure of accounts has been done properly or no. So this is basically, this is to be done. Reconciliation is done on quarterly basis. This is done on quarterly basis. Now we have a internal audit of DP. This is another thing which is also done by CACS CMA, CMA can do. Okay, and we will check whether they have complied with the DP has followed the laws or not. Depository participant has followed the laws or not. This was about reconciliation. And the third type of audit is called as concurrent audit. What it is called? Concurrent audit. It is about delivery instruction slip. Audit about DIS, delivery instruction slip. There are issuance of DIS and issuance and verification of DIS, delivery instruction slip. I'll tell you what it is. Let's come to it. So just note it down that these three kinds of audit is done, which is done by company secretary. Reconciliation audit, DP, whether they are functioning properly, and the last one is issuance of like how you have a checkbook. So someone will check how many checkbooks have been issued, how many checkbooks have come back. Similarly, when now we have complete demat. Earlier, what used to happen? Like my mom, she used to call the broker and tell the broker sell. She didn't have a demat account. She didn't have the expertise to do it herself. So she used to call the broker. That she used to give the instruction to the broker. She used to give a instruction to broker to sell the shares. So he used to sell it. Now he will tell that, listen, you have got a on call you got. So they used to issue something like a checkbook, where instruction I used to give in writing later. I used to tell them that, listen, I've told you on phone. Now this is there. So audit will be done. How many DIS were issued? How many were returned? How many were done according to the client's instructions, etc. Let's see what it is. We are done. See, the third type of audit they have covered is concurrent audit. Now, concurrent audit is when you are opening a demat account, a delivery instruction slip is issued. A DIS is issued. A DIS is basically like a bank passbook, where whenever a client has given instruction to the broker manually, so that instruction slip will be checked. This DP has to get this check from audited through a company secretary. Okay, so how many have been issued, how many booklets have been given, how many loose slips was given, when it was dated, whether it was stamped, signed by the party, okay, etc. So only little bit, and that's it. Then now they've added one thing about cyber security, that SEBI cyber security and cyber resilience framework by DP, that comprehensive cyber audit. Now they've also said one more type of audit, that you should do a cyber audit once annually. So we'll add the fourth one which has come, the fourth one type of audit. Okay, the 4 types of audit. The fourth one is a newer one. It is about cyber audit. Has to be done. Okay, whether you are complying with all the technologically best practices or no. So 1 year, within 1 year you have to keep doing. Let's see what are the points. Cyber audit. Okay, at least once it should be done annually in a year. Okay, a declaration will be given, a compliance declaration, a declaration to be signed by the MD, CEO, etc., that they are complying with the SEBI circulars on cyber security. So SEBI keeps issuing that, keep maintaining cyber security. So a declaration will be given by them. Audit will be done. Critical asset classification. Depository participants are required to classify and identify assets based on sensitivity, whether they have complied with the details or no. Inventory maintenance, whether they have maintained all the inventory such as hardware, software, digital assets properly as per law or no. Vulnerability assessment and penetration test, VAPT, okay, VAPT, vulnerability assessment and penetration test at least once per financial year will be done to see whether the infrastructure detects vulnerabilities and security, security, it is secure to protect from attacks. So 5 points, just remember this, that SEBI nowadays keeps issuing to companies to maintain proper cyber security. So they have said get a cyber audit done once a year. The declaration should be given from the MD that they have complied with everything. Now 2 points, they will check your inventory, hardware, software is as per law or no. Critical asset classification, they will state that this is personal information, it is critical factor, it is sensitive factor, so whether additional security is provided for that, and vulnerability test will be done. With this we have completed the entire chapter. Thank you. Okay, so we completed the entire chapter. Now we'll go to the next one and we'll complete the next chapter also. Okay, what is the next chapter? Your SEBI market intermediaries. Okay, now your SEBI stock market intermediaries. Till here it is clear, yes or no? Write in the chat box clear. I want to complete in the next half an hour. I want to complete 2 chapters. So I need your support just in the chat box. Is it clear? Write clear in the chat box. Yes or no? So after that you are free. I am completing your full part A for you. Part B you can have all the time in the world to then complete your part B nicely, peacefully. And I'll tell you also a strategy to complete part B. First you tell me in the chat box, am I clear in the chat box? Okay, clear. Sona, Pradeep, great. Okay, so whatever I am covering, only those if you can keep noting down in your books, and you will be able to build your answer. You're sufficient, because 5-mark answer will come if you just understand. You will be able to elaborate also. Now we will be looking at security market intermediaries and completing it. Okay, so just give me 2 minutes. We'll come back and complete this. Okay, great. So you all can just go through your intermediary chapter, or simultaneously you can do some part B chapter if you want, till I start this. Give me 2 minutes, I'll be back. Okay. Okay, so am I audible and visible in the chat box quickly? Am I audible, visible in the chat box? So I can quickly start and complete. Yes or no? Audible, visible in the chat box. I'll start and complete this chapter for you. Okay. Waiting for you to reply, so it'll be faster you reply. If nobody's replying, you take the responsibility and mention it. Okay, so I can quickly start. Okay. Till that, just let's look at the intermediary question that they've asked. They've asked, great. Okay, so we're just looking at the question that they've asked. Credit rating agency, their minimum net worth. Then they've asked share meaning of this, their activities, share transfer agent. Then they've asked grant of certificate, primary market, secondary market, primary market intermediaries, appointment of compliance officer, then general obligation for investment advisor, conditions for certificate, role of portfolio managers, research analyst. Okay, then they are just looking at what all past exam questions they've asked. So we know we cover it when we are doing it. Custodian, broker, sub-broker, banker to the issue. So very simple questions they've asked. Not to make... Debenture trustee, banker to the issue, debenture trustee, foreign portfolio. Okay, done. Chalo, let's start. Let's start with this chapter. Hi, so we start with a chapter called as registration of SEBI intermediaries. Now, we have to understand one thing, that investors are here. Okay. Now, let's say these are investors. Now, companies, when companies want to raise capital, company wants to raise capital, they go and they raise it from investors, right? They want to raise capital. Now, companies nowadays might enter into fraudulent activities, etc. They might try to fool. So, in order to protect the investors, we have a body called as SEBI. SEBI is a organization, a regulator of securities market. So, they will look into the matter that the investors are not fooled, the investors are not put to loss. So SEBI doesn't come by themselves. SEBI does not do the regulation of securities market themselves. What do? They appoint a intermediary. They appoint SEBI intermediaries. So the SEBI intermediaries look after the securities market. We know that the job of SEBI is to protect and develop securities market. But SEBI does it with the help of its intermediaries. Okay. Sir, can you tell me intermediaries example? So intermediaries can be divided into capital market intermediaries, or could be primary market intermediaries. Okay. Primary market intermediaries, or I could say secondary market intermediaries. Your secondary market intermediaries. For example, now you tell me, if intermediary means SEBI helpers, okay, and all the intermediaries in India of SEBI have to be registered by SEBI and get a registration certificate. So it is a registration certificate is given under section number 12. okay, of SEBI Act. SEBI will look at your net worth, SEBI will look at your track record, SEBI will look at the infrastructure that you have, SEBI will look at the promoter details and then grant the certificate. Okay. Now, as I told you that it could either be a primary or secondary market intermediary. Okay, sometimes both also. But let's see. If I tell you someone is a registrar to the issue, registrar to issue. So it is at the time of issue it is coming. So it's a primary market intermediary. Another, if I ask you underwriter, underwriter will come here. Underwriter will come as a registered market intermediary. If I tell you banker to the issue, at the time of issue it is coming. So it will come here. Banker to the issue will come again as a primary market intermediary. In secondary market intermediary are those which help you in trading. Example is broker. To maintain your portfolio, etc. is a portfolio manager. Going to come here. Investment advisor can come here. Investment advisor can come here. If I say that an issuer is there in order to help you decide whether to invest or not invest, there are some credit rating agencies. Credit rating agency, their job is to give credit rating. 5-star, 4-star, 3-star, they have their AAA, AA, minus B. So all those credit ratings will be there. It gives like how movies are being rated, your companies will be rated. So these are all at the time of issue. That's why it's called as primary market intermediaries. These are all at the time of trading. That is why it's called as secondary market intermediary. So let's look at the points. Okay. Okay. Now, initially we can write that SEBI regulates the securities markets through its intermediaries. Okay. Now, section 11 says it is a duty of SEBI. As we saw, the object of the act is given in section number 11 of SEBI Act. Okay. In 12 they give this registration certificate. 11 they say that it is the duty of SEBI to develop and protect the securities market and to register various intermediaries. All these intermediaries, what they do, we will see. Okay, all these types of intermediaries are there. Some are come at the issue stage. Merchant banker comes at the issuing stage, is another intermediary. We'll see what they do. Okay. So these are your primary market intermediaries. Normally they tell concept we will know. Net worth we forget to tell. Okay, net worth, because they also tell the net worth. Now net worth we don't remember. So I've written down the net worth first only. Okay. The following is a market intermediary in the primary market at the time of issue. Merchant banker, registrar and share transfer agents, underwriter, banker to the issue and debenture trustee. In order to do that, they need to have a net worth. Merchant banker need to have 5 crores net worth. Underwriters need to have 20 lakh net worth. Debenture trustee need to have 10 crore net worth. This you can just counter check from your module. Similarly, secondary market intermediaries are there. So please note down the net worth because they ask in the exam. Okay, and then concept you can build, but net worth we need to know. So the secondary market intermediaries are your portfolio managers. They need to have minimum 5 crores. Net worth to set up. You can't just start with 10,000 rupees, etc. You need require this much net worth. Next, stock brokers and custodians, 50 crores. Then there are other intermediary markets also which are involved, which could be called as credit rating agencies. Okay, credit rating agencies. So they need to have 25 crores net worth. Very, very important. Then investment advisors. Now investment advisors, what are they? They are in the business of giving investment advice with respect to securities for consideration. So they will take money and then give you investment advice. If there is no consideration involved, then it is not an investment advisor. For investment advisor, they take money and then give you investment advice, and that investment advice is with respect to securities. Okay. Investment advisors who are non-individuals. Okay, so investment advisor could be an individual or a company. So if it is a company, then they have to have a net worth of at least 50 lakh rupees. investment advisors who are individuals will have a net tangible interest of net tangible assets of at least 5 lakh rupees. DPs will have 10 crore. So these thresholds, if you remember the concept, we can build. So you want, you can take a screenshot, note it down, learn it, done. Okay, so these are net worths that they have given. Here they have given the net worth for primary market intermediaries. Done. So the net worth I won't repeat, you have to learn. Sometimes they ask in the exam along with net worth. Concept I'll teach you, it's very simple, you can easily build. Okay, we'll directly start with the provision. Now very simple, if any intermediary is interested, they will make an application. Okay, in Form A, application is made in Form A. Then the process, the eligibility will be seen, the thresholds will be seen, the all the necessary things will be seen, net worth will be seen. They can ask for additional information, they will verify those additional information, and after hearing, they will grant the certificate. They can, SEBI also has a power to reject. So this is a small basic flow they have told you, just in case. They can grant the certificate and they can reject the certificate also. But before rejecting, they will give you a opportunity being heard. Now just remember that these are common thing that any intermediary comes, we will write the meaning. So remember, any intermediary comes, they'll ask a very simple direct question. So intermediary comes, you'll write the concept / meaning. Then you'll write the net worth if you remember. Net worth you'll remember. Then just some points I will tell you, some common points that you can fit for all intermediaries. These are some common points that you can use for all intermediaries to build your answer. Let's see. So just few points you will keep noted down. So it will be easy for you. Just write it down. So they will look at whether you have adequate infrastructure. Okay, like adequate space. Now this is general. This is general for all. Before granting, the following factors will be seen. So it is common. This you can fit in every answer to build it up. That SEBI shall take into account the following aspect before granting registration. So they will look at the infrastructure, they will look at the past experience, they will look at the capital adequacy, they will see if there is any disciplinary action. Okay, they will see if you are a fit and proper person, etc. Now, if they want to apply, now this certificate is given. Renewal can be done at least 3 months before the expiry period. So this also is common. Whatever I am doing here is common. You remember, write it down. You have to only write it. Any intermediary comes, you will build these points. Okay. They have to maintain a certain code of conduct. A code of conduct needs to be maintained. Means the behavior, how they will deal. Intermediary and its officers and the KMP shall abide by the code of conduct given in Schedule 3. So I am teaching you first a generic answer which you can use it and build in everything. First you'll write the concept, which you will, whenever you will, I'll teach you each concept. Then you'll write the net worth, and then you'll write the common answer which is here to build your answer. So code of conduct means what? They'll abide by the code of conduct, such as they will act honestly, fairly in the interest of the clients. They will exercise due diligence, care, okay, and they will avoid conflict of interest. They will comply with the laws. Okay, so simple lines. The intermediary shall try to avoid conflict of interest as far as it is possible. Okay, they will work to protect the interests of investors. They will follow the best corporate governance laws. They will maintain the books of accounts as mentioned by SEBI. They will ensure that proper KYC is done before onboarding their clients. Internal audit will be done as required, and I told you concept of intermediary internal audit you can write always that company secretary CA, CS, CMA is entitled to an internal audit. Compliance officer will be appointed. Okay. Now SEBI, now one more point you can write that SEBI can always at its discretion appoint a investigating authority to investigate into the complaints on basis of any complainant or suo motu. They will give a reasonable notice to the intermediary before taking action, and then SEBI will pass any order as it deems fit in the interest of public. These are common points that you can build every answer. Inspection, disciplinary action, every intermediary is required to appoint a compliance officer for monitoring the compliance of this act. Liability in case of default. So this also you'll write that in case if, so it's a beautiful thing that we are doing. We are learning a common thing which we can fit in everyone because it is common for all intermediaries. A intermediary shall be liable for contravention of the act if they are not furnished any information, if they do not cooperate, okay, if they have not failed to follow the directions, if they have not paid the requisite fees, or if they violated any of the conditions, then the liability can be taken. Done. So we are done with this, and now simple we'll get into the concept of each intermediary. So generic points we have done. These points you will learn fitted to build all your answers. Now we will understand the concept of each intermediary. The first is called as merchant banker. A merchant banker is a person engaged, is any person engaged in the process of issue management, okay, buying, selling of securities. Origin, the merchant bank, it started from the merchant banking services by Grid Lays Bank. Merchant banking regulations are in 1992. Net worth you will give. So what does they do? They are in the process of issue management. And what are the functions of a merchant banker? Issuing shares, underwriting, giving advice. They act as underwriters also. They can do project management. They can do loan syndication. They do issue management. They can also act as banker to the issue. They oversee the entire issue management process. Done. Okay, rest all you can write. They will abide. These are all common points which I had written in the above only. They abide by the code of conduct, maintain the books. So these are common for all. Abide by the this. They shall not work against the interest of investors, etc. Okay. Now the next intermediary, the second intermediary that we see is your registrar and share transfer agents. Okay. Now registrar and share transfer agent. Now remember there are two categories. One is RTA, which only do the issue management work. One is registrar to the issue. Registrar to the issue is at the time of issue of shares. They will collect the application forms. They will do the allotment. They will do the refund orders, etc. Share transfers are mainly secondary, where they do share transfers in the secondary market. Transfer of shares, transmission of shares. Now when we see RTA, they are doing both. So there are two categories. One category does only one of them, and another category does both the work. Okay, category 1 does both, and category 2 does either a RTA or a share transfer agent work. So either they do this or that. In category 1 RTA, they do both. So remember this point, that the expression RTA is a combination of two words, which is registrar to the issue, which comes in primary market, and share transfer agent, which comes in the secondary market. So if an intermediary is getting registered in category 1, they are category 1 RTA, means they are the best. They can do both the work. Category 2 can do either one of them. Okay. Now if you say, sir, what all work do they do? So very simple. Just remember this, that in issue, what will they do? Collect the application forms, maintain the proper record, ensure that allotment is done properly. Okay. Allotment order, refund orders are done properly. Okay. And if it is a share transfer agent, then share transfer and transfer transmission they will do. Simple. Net worth requirement is there for category 1 50 lakh rupees, and for category 2 25 lakh rupees. Remember, write it down. Market is important. Okay. Then we see the third one is underwriters. Underwriters, we know, I don't think they will ask you. Very, very simple. Underwriter is an arrangement where the issuer where the underwriter is a person who undertakes to subscribe to the unsubscribed portion, okay, in a issue. And then you write the act, and then you write the general points that we have done. Now we see banker to the issue. The banker is a bank. So banker to the bank means a scheduled bank which is doing issue. So at the time of issue, what will happen? Application, allotment, refund, and payment of dividend interest, if any. And the general obligation I've taught you in the beginning, that you have to write for all. Okay. Debenture trustee also, we know what they are. They protect the interest of debenture holders. Then stock brokers. Now stock brokers are a secondary market intermediary, okay, which help in transfer of shares. They help in buying, selling and dealing of securities. One, okay. Now a sub broker is a person who is working under the main broker. He directly is not a member, but he is working under a person who is a member. Simple. So all this is common for all the intermediaries, getting a half yearly audited certificate from the CACS CMA. Then comes portfolio managers. Now mark, portfolio managers is important. The portfolio management rules 2020. Portfolio managers manage your total portfolio, the total number of securities that you are holding. Portfolio managers could be of two categories. One is discretionary, the other one is non-discretionary. Sir, what do you mean by discretionary? Discretion means what? The portfolio manager has the discretion, as the option to trade without the permission of the investor every time. So without the consent of this, every time we can keep doing, because initially the a client is only telling that you go ahead and deal, don't ask me. So here he can independently manage the account, okay, in accordance with the client. He will independently manage. So before this, a agreement will be made between the portfolio manager and the client, and it will be told whether the portfolio manager has the discretion or he doesn't have the discretion. In that, he will every time have to take permission of the portfolio manager, okay, of the owner. So here the net worth is 5 crore rupees and minimum investment amount. Now mark this as important. Here what happens is, if a portfolio manager is there, now they take high net worth individuals only. Obviously only a high net worth individual will be able to afford a portfolio manager. So the portfolio manager shall not accept funds less than 50 lakh rupees from clients. Okay, so minimum he will accept is minimum 50 lakh rupees from client will be taken. Now the general points I have written in the start, everywhere we can write. A custodian is a person who has a custody of something. Here custodian services in security means what? They have the custody of all the physical documents, gold, mutual fund documents, etc. Now see, custodian will maintain custody of physical gold related instruments, any kind of documents he will keep, safekeeping will be done. So it includes maintaining of securities, gold, all this account, the title deeds of papers. Okay, he will keep the client informed, maintain the proper conciliation, and he should have a net worth of 50 crore rupees. Then comes investment advisor. Now understand who is the investment advisor. This is also important category. Investment advisor is a person one who for consideration is the second point. Consideration means what? For money, is engaged in the business of providing advice to the clients. So they will provide for consideration. You have an investment agreement with them. Okay, the investment given through newspapers is not counted, which is widely available to public, is not considered as investment advice. Means in the newspaper, if I printed an article, so that is available to all. Here I give, the person is giving for consideration to a specific person, and it is an investment advice related to securities. So for example, I take 10,000 rupees from you and I say go and buy security shares of Reliance Industries. This is the investment advice. Okay, and they are regulated by the Investment Advisors Regulation 2023. They need to have a net worth. Investment advisors who are non-individuals have to have a net worth of at least 50 lakh rupees. Investment advisors who are individuals will have less, 5 lakh rupees net tangible assets. Okay, then general points they have given you again. Research analyst. Let's understand who's a research analyst. Now, what does a research analyst do? So, research analyst, what do? Is they research about the market, they research about companies, they research about the trends, they give a target by exit price, buy price. If you've seen in WhatsApp, sometimes they get that this is the stop loss, this is the target. So they create this and they give it to multiple people. So a company can subscribe to a research analyst firm to get regular research papers. Okay. So here a research analyst seeks a regular so they regulates research analysts. So this regulation regulates research analysts. They are engaged in preparing reports and giving opinions. Okay. Research analysts are primarily responsible for giving buy sell advice. Now see what are they responsible for? For giving research reports, buy sell recommendation, price targets. Okay. Offering any opinion concerning an open offer. So that all is given. Now again, the common points you'll write, they have to get a certificate of registration, etc. Everything else you can write the same. Then comes very important credit rating agency. So what is a credit rating agency? So it is like how you see movies, you get 5 stars, 4 stars, 3 stars. So a credit rating agency is an organization which evaluates the credit worthiness of a company. So what will you write? A credit rating agency is an organization that evaluates the credit worthiness of a organization. Clear? Now they establish link between risk and return. See, if today I want to buy in an IPO, I wouldn't know now which one to invest in, which to invest. So these credit rating agencies give a rating that comes in the prospectus, which helps assist the investor's decision making. So they don't give a buy or sell advice. They are not involved in giving buy or sell advice. They give independent, unbiased opinion about the credit worthiness of the company, how good or bad it is on basis on the fundamentals. Okay. So CRISIL in India, CRISIL was the first CRA. Then came ICRA, CARE, Fitch, Brickswork, Samira, etc. Then all internal audit is for all the intermediaries that you can write common points. Okay, general points again. Then depository participants, we have a full chapter. FPI also we have done it initially in the first chapter only. FPI, foreign portfolio investors. Categories we've done. Now just remember one thing, that to FPI. So FPI, foreign portfolio investors, invest up, okay, less than 10% in listed companies. Okay. Now they will also have a demat account. Now this demat account, they cannot have it with any depository. They will have with a designated depository participant. So with a depository participant which has been recognized by SEBI. Okay, so they have to get approval from SEBI to give this depository participant services to foreigners. By only one thing, government say, listen, just do a proper KYC on them. Okay, so that will be checked. They will take additional fees for allowing you to give services to foreigners. Then comes your KYC regulation. So what is it? That it is a centralized body which contains all the KYC details of a particular person. Okay, so it's an intermediary which provides the initial KYC. So any information is there. For example, if a investor is there, a KYC has been done. So all his information will be stored in a KRA, KYC registration agency. It's an intermediary of SEBI where all the data is stored. So all the information will be stored in this about the customer. So anytime any intermediary wants to do, they don't have to every time ask the investor. They will approach in this repository and take it. Okay, with this we have completed the entire chapter. Thank you. Okay, now remember one thing, guys. now I have completed your entire part A. Only one chapter is there. Now I would want only one chapter is there, which you all can watch it from the dream batch. Okay, dream batch. Now remember one thing. Now I would advise you all, after you all have done this, maybe take 15 minutes more to complete it, because one chapter always you get option etc. You can do it. Now you should start with your part B. Now you should start with part B, and I'm giving you the order in which you have to study. First complete, see 60 marks is 40 marks I've covered for you full. Only one chapter is there that you can watch. Now you start with ICDR. Directly go open the dream batch, complete the dream batch link is there, gives you access to all the lectures in 2x speed, 1.5x speed. Finish ICDR. After you finish ICDR, then second go to LODR. Second complete LODR. Okay, then third you can complete your insider trading regulations. Fourth, you can complete your delisting. Fifth, you can complete your buyback. Okay. Sixth, you can start completing your mutual funds, and then from your seventh you can come here if you this seventh. Okay, so these are your chapters from where the questions will come. Okay, target to complete each one, at least the order which I have told you, the important ones are first. So complete this, more or less your full subject will get over in this. Okay, and then the other parts, maybe if you want, the eighth is takeover. Now takeover takes time, so quickly go through it and finish it. So I have helped you complete major part of part A, only one small chapter. So start with part B now, only because almost you will be able to attempt part A nicely. Okay, I have covered everything for you. Go ahead, start in this order. Remember, you have to keep 1 hour for CMSL sums. CMSL sums has to be done. 1 hour you have to keep it. Okay, anyhow, fix it now only when you want to do it, maybe in the morning, etc. But 1 hour you do it, and just before the entering into the exam hall, 1 hour before, start studying your part A again. So just before entering into the exam hall, if you refer your part A again, then you will be able to easily attempt part A, and then part B you are doing it now till your entire night you can complete it. You have good enough time. That's it. Okay, so with this I complete my marathon. I help you complete a lot of chapters. Now it's your job to go ahead and complete it from the dream batch. Don't think my lectures are not available. In dream batch you get the lectures. Please start it in this order. Complete it, major part will get over. Okay, that's it. Even if you not able to complete all, at least if you go in this order, by night you have to complete these 8 chapters. So target it to complete in 45 minutes each chapter. 45 minutes each chapter should get over. Each chapter should be over. Time it now. Only ICDR you can take 1 hour. Only ICDR you take 1 hour. Rest all the chapters in 45 minutes completed. That's it guys. Thank you so much. Wish you all the very best. I will see you all tomorrow again with the next marathon. Take care guys. See you. Bye. All the very best. Nothing will come outside than what I have done. Okay. Or in my detailed lecture also, it won't come outside of that. Take care guys. Bye.